Good evening, friends. Good evening, friends. In Sunday's class, we completed interest rate swap chapter along with the interest rate risk management also. Today, we will discuss the chapter currency swap. We have this as a separate chapter because some concepts like interest rate parity along with interest rate swaps merges and comes together in this particular chapter. Hence, we are having this as a separate chapter, currency swaps. Substantially, we tried to complete in today's class. One or two sums left, we'll be doing it in the next class and completing the chapter, currency swap. Next class, we'll start with another small chapter called as mergers and acquisitions, which we can comfortably complete in Saturday's class. Next class and Saturday will be having two more classes. Saturday fully mergers and acquisitions we will be doing. Next class, however, we can just do currency swap and the balance in the mergers and acquisition chapter. So, today I think all got the message that class is at 5:45. Yeah? Yes, I also said this in the last class. Yes, message I sent that currency swap is going to be started. Yes, I only typed the message specifically and sent you to inform you that be here on time so that we can start discussion. No, message go. See. Shall I proceed? Like this, your lover will send a message, in another half an hour I am going to get married. As usual, you go late, okay. So it will gone, okay now. Like that is going to happen. Okay, now. See, before we formally discuss the currency swap transaction, please let us discuss a small concept called as parallel loan. This, if you formalize it, will become a currency swap agreement. So question number 9 discusses about parallel loan. With this, we'll start the momentum for the currency swap. Then move on to question number 1, where you can see formally how the currency swap operates, and then as usual do transformation of asset liability, swap arbitrage and swap valuation. Take question number 9. It is a situation in which we'll be having an arrangement called as parallel loan arrangement. Please. It is not exactly currency swap but very similar to currency swap. Please. Take question number 9. Apply your mind. Let us read the question together. McDonald's hamburger company wishes to lend. Please, no sound, please. Settle down. Can I start that? Now already 5 minutes gone. Can I start that? No. At 10 minutes gone. McDonald's hamburger company wishes to lend. Please stop that. Wishes to lend $5 lakhs to its Japanese subsidiary. At the same time, Yasufuku Heavy Industries is interested in making a medium-term loan of approximately the same amount to its US subsidiary. The two parties are brought together by an investment bank for the purpose of making parallel loans. McDonald's will lend $5 lakhs to US subsidiary of Yasufuku for 4 years at 13%. Principal and interest are payable only at the end of 4th year, with interest compounding annually. Yasufuku will lend the Japanese subsidiary of McDonald's 70 million yen for 4 years at 10%. Again, the principal and interest annual compounding are payable at the end. Current exchange rate is 140 yen to dollar. However, the dollar is expected to decline by 5 yen to the dollar per year over the next 4 years. If this expectation proves to be correct, what will be the dollar equivalent of principal and interest payments to Yasufuku at the end of 4 years? What total dollars will McDonald's receive at the end of 4 years from the payment of principal and interest on its loan by US subsidiary of Yasufuku? Which party is better off with the parallel loan arrangement? What would happen if the yen did not change in value? Calculate the break-even maturity future spot rate. These are all the questions which has been given. Okay, please. All of you, I'll just give a minute time. Please, I now saw that nobody has listened to the question when I read it. Okay. Okay, still I'll give you, otherwise you won't understand the answer what is going to be discussed. Please, with intent, apply your mind and go through the question once again before you start with the solution. Please, all of you. Don't talk. Those who are coming now, please come and settle down without noise here. Please. Shh. Stop talking. Stop talking. Shh. Please get in quickly. Okay. Settle down. Shall we start our discussion now? No. Please focus here. Request. Now, those are coming now. We are doing question number 9 in the chapter Currency Swap, where we are getting started with a small concept called as parallel loans, which will be formalized into a swap arrangement in the next discussion. Settle down. Shall we start? Now, let me explain you the transactions and then see how this arrangement is good for both the companies. See, two countries are involved, namely what? US and then Japan. There is a holding company. There is what? Holding company in US. There is a holding company in Japan. Can I proceed on? There's a holding company in US, there's a holding company in Japan. This US holding company is having a subsidiary. It is having what? Subsidiary. Local or foreign subsidiary? Foreign. It is having a subsidiary in which company? Japan. So US company is having a subsidiary in what? Japan. So this is a subsidiary of what company? US company. Subsidiary of US company. Situated in what? Japan. Like that, Japanese company is having a subsidiary in US. So there is a subsidiary of the Japanese company in what? US. I call as SJ. Subsidiary of Japanese company situated in US. Okay. Now, understand, these two are entirely different entities. They don't know each other. They don't know what? Each other. Now, the situation is as follows. Shall I start up, please? Situation is as follows. The subsidiaries requires funds for performing their operations. They may want some extra funds. Normally, who gives funds to a subsidiary? The holding company. You can even borrow outside and all, but they have some restricted borrowing capacity, etc. Mainly, holding companies operating through a front called as what? Subsidiary in the other country. So these subsidiaries requires what? Funds. Okay. Now, my question is, this US subsidiary in what? Japan wants money for its operation in dollars, yen. Because it is operating in what? Japan. Suppose a Ford subsidiary is there in India, they don't want money in dollars. They want money in what? Rupees. Because their primary location operation is what? In India. So like that, they want the money in what? Yen. Okay. So the US subsidiary wants money in what? Yen. Like that, the Japanese company subsidiary in US, operating in US, wants the money in what? Dollars. Okay. Now, if these two companies don't meet each other, it don't meet what? Each other. What happens here? First, US holding company will be having all its wealth in dollars. Will be having the money in what? Dollars. So what it does here, it is going to convert the dollars into what? Yen, and give a loan to what? The subsidiary in Japan. Response is or no? No. For example, how much loan is required? How much loan is required by the subsidiary? How many days here? 5 lakhs. Next, what is Japanese company? How many days here? 70 million yen. 70 million means what? 7 crore. That is, the US holding company having money in dollars should convert into what? Yen, and give a loan worth how much here? 70 million yen. Loan should be given. Everybody, are you have the clarity or not? No. Like that, the Japan holding company will be having its money in what? Yen. Its subsidiary wants the money in what? Dollars. It will convert it yen and then give it in what? Dollars. How much will it be giving in dollars? Dollar 5 lakhs loan will be given. Everybody yes or no? That is, the holding company in US will convert a dollars wealth into what? Yen, and give a loan worth 70 million yen. Yes or no? Like that, the Japan holding company will give its subsidiary in US, what is a dollar loan by converting it into what? Dollars. Point number 1 is conversion involved. Okay. This will obviously happen in what rate? Spot rate. And every year interest will be paid or not? The subsidiary will pay interest to what? Holding company. It will be having the money in what? Yen. It has to convert into what? Dollars. And pay interest to holding company. So no. Or it will pay the interest in what? Yen. They will be receiving interest in yen. Has to convert into what? Dollars. Like that, this pays interest in what? Dollars. It will be receiving interest in dollars, convert into what? Yen. Finally, when repayment happens, when they repay the principal, they have to convert it back to what? Dollars. And they have to convert it back to what? Yen. All this transaction happen or not? The problem is risk. Every time when they want to convert the yen into what? Dollars or dollar into yen, we'll be not having a known exchange rate today because we are exposed to what? Risk. So these two companies are now having what? Foreign currency risk because they're giving a loan in foreign currency to a subsidiary. What I'm saying? So there's a currency risk that is involved in these two loan transactions because there's always a conversion and then what? Reconversion. Convert dollar into yen and then give loan. When they repay interest and principal, realize and reconvert into what? Dollar. Same thing is a problem for what? Japanese company. There's always a exchange rate risk that is going to be what? Present in this set of transaction. Point number one. Agreed or not? Yes, sir. Already we have seen that when I convert and reconvert, I not only have a risk, I also lose spread here. Yes, because I buy at banker's selling rate. But I have to sell back at what? Banker's buying rate. So spread will be made by the banker in between or not. Every time interest is received and paid as well as what? The loan repayment. In all these cases, I am both having a currency risk as well as what? On conversion and reconversion, doing what? Losing what? Spread also. So this is a problem in this particular loan arrangement. Everybody are going to have the clarity. So, okay, now this is point number one. Now, an investment bank. I think you all know about investment banks now. That generally, I'll just give a small introduction and then proceed. Not required for this sum. See, there are two types of banks here. Our banks are all commercial banks. What banks here? Commercial bank. There are banks called as what? Investment bank. Commercial banks, what the main aim is only what? Lending and borrowing and then providing what? Other services associated with it. Mainly deposits and borrowing happens to be the main aim of what? These commercial banks. They give agricultural loan, they give jewel loan, they give housing loan. So these are all the activities of the normal banks. Investment bank is not for that. Investment bank always does some complex financial activities. They go as what? The mediator for merger deals. They do due diligence for what? Merger deals. They facilitate mergers. They only generally deal in what? Swaps and all. They deal with what? Some complex derivative products. When a company goes for IPO, company goes for what? IPO. Mainly they can even act as a merchant banker or generally does all the legal work for what? The IPO. Starting from pricing to what? Till say getting itself listed, doing market roadshow, everything they want to handle. So investment banks are those banks which does not do purely banking services. They do all this. They arrange for swaps between two parties. They do broking service. So many things will be done. They do multiple types of things. It's called as what? The investment bank. Just for you to understand that, sir. Can I proceed? Now come back to the discussion. An investment bank sees these two companies. These two may be client of the investment bank. They said, why you both suffer? Why can't you go for a parallel loan? Why can't you go for what? A parallel loan. Parallel loan means it is very simple. That's how the transaction take place. US and then what? Japan. All of you can start up? No. There is a holding company in what? US. There's a holding company in Japan. This company is having a subsidiary in what? US company, subsidiary in Japan. Japan company is subsidiary in what? US. They say, why you should give loan to your subsidiary? Please give the loan to the other company subsidiary. Did you follow what I am saying? Now, instead of giving like this, give what loan? Parallel loan. Let US holding company give loan to Japan company's US subsidiary. Let Japan company holding company give loan to what? US company's Japanese subsidiary. Everybody have the clarity or not? So they will give how much loan? $5 lakh loan, and they will give how much loan? 70 million loan. Everybody having the clarity or not? 70 million yen as a loan. So $5 lakh given as loan and 70 million as what? Loan. Can you tell me what the dollar interest rate given in the question? All of you help me out with the number, please. What's the number? How much percent? 13%. They give it how much percent? How much percent? 10%. Don't think interest rates are different. Across two countries, interest rate cannot be what? Same. It will be offset by the exchange rate parity. Can I proceed? So this is regarding the transaction. Now, in this case, now tell me, is a Japanese company's US subsidiary got its required fund or not? Yes. It got the fund from what? US company. And US company's Japanese subsidiary got the money or not? Yes. It got the money from what? Japanese subsidiary. Now tell me, this is also home currency dollar. This company also having the money in what? Dollar. So here there is no need for conversion and reconversion. Same thing happens here also. So this type of loan arrangement is called as what loan here? Parallel loan arrangement. Everybody, yes or no? The only thing is, when you go for a parallel loan arrangement, your principal should be equivalent, not equal. Principal should be what? Equal. Equivalent at the spot exchange rate, both principal should be what? Equal. So what the spot exchange rate in this case here? $1 is equal to 140 enna kadaba. Appo $5 lakh is equal to 500,000 into what? 140 gives how much crores here? 7 crores yen. 7 crores means what? 70 million yen. That is at spot rate, these two principles are what? Equal. That is the condition, and it will be given at the respective country's interest rate. I cannot ask an Indian company to give a loan at 2% because US interest rate is what? 2%. That's a different currency interest rate is having what? Different currency interest rate. And obviously country having low interest rate need not worry. It will be having a strong currency and what? Vice versa. We'll look at those issues later. Can I or not? No. This is what we can ask what arrangement here? Parallel loan arrangement. In this case, tell me, is there any conversion from dollar to yen or yen to dollar? Not at all. Since no conversion is involved, there is no exchange risk. Point number one, yes or no? And also there is going to be no need to have a spread also lost to the bankers. So this arrangement is called as a parallel loan arrangement. My first discussion, everybody will have the clarity on We'll continue further in the next stage. Let us write this first situation and then go for the next one. Okay, right now. Parallel loan, give the heading, chapter number 10. Chapter number 10, currency swaps. Shh. Please, all of you settle down. Chapter 10, currency swaps. Shh. Chapter 10, currency swaps. Okay, write down. Problem number 9. Question 9. Parallel loan arrangement. 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 Okay. Give the heading. Understanding the transaction. Give a heading. Understanding the transaction. Understanding the transaction. Okay. Copy point number 1 diagram. We'll explain this next. Okay. Copy point number 1 diagram. US, Japan. So I just made a space not to intersect line. That's all. Okay. US, Japan. US is having a holding company in US. Holding company in Japan. Japan holding company is having subsidiary. So Japanese company, SJ means what? Subsidiary of Japanese company. In which country? US. Subsidiary of Japanese company in US. Subsidiary of US company in what? Japan. Subsidiary of US company in Japan. I think diagram is self-explanatory. This US company subsidiary wants some loan or not? They want loan in dollars or yen or yen. They're operating in Japan. Their functional currency is what? Yen. Obviously, you have to give the loan in what? Yen. So please just give the loan in yen. 70 million yen. 70 million means how many crores? 7 crores or 700 lakhs. 70 million yen. The Japanese company subsidiary in US wants a loan in what? Dollars. So holding company in Japan gives loan, how many loan? $5 lakh. Gives loan $5 lakh. Gives loan of $5 lakh. This you all finished copying or not? No. Same point you continue writing. In this case, the holding company in US, has to convert its dollar funds into yen has to convert its dollar funds into yen and then provide loan to its subsidiary. And then provide loan to its subsidiary. And then provide loan to its subsidiary. Full stop. When interest and principal is repaid, when interest and principal is repaid, when interest and principal is repaid, it has to reconvert the yen to dollars. It has to reconvert the yen to dollars. It has to reconvert the yen to dollars. Reconvert the yen to dollars. This you can call as point A, Papa. Call as point A. Point B. Point B. The same problem exists for the Japanese company also. The same problem exists for the Japanese company also. I don't want to dictate once again. Convert the yen funds into what? Dollars and give the loan. On repayment you have to reconvert and realize it. Okay, same problem exists for Japanese company also. Point C. Due to this transaction, the companies are exposed to currency risk. Due to this transaction, the companies are exposed to currency risk. And moreover, they will lose spread. On conversion and reconversion. And moreover, they will lose spread on conversion and reconversion. And moreover, they will lose spread on conversion and reconversion. Did you follow what I am discussing? No. All this comes under point number 1. Yes, right. Point number 2. Copy this diagram. US, Japan, holding company in US, holding company in Japan, HUS, HJ, holding company in US, holding company in Japan. Subsidiary of Japanese company SJ in US, subsidiary of Japanese company in US. Yes, US na subsidiary of US company. In which place? Japan. Subsidiary of US company in Japan. Now tell me, they will give to their own subsidiary or to other subsidiary? Other. So holding company US, put an arrow mark and write $5 lakh at how much percent? 13%. $5 lakh at 13%. Holding company in Japan gives yen 70 million at how much percent? 10%. Yen 70 million at 10%. Yen 70 million at 10%. Okay. Next line, right, in the same point. When they give loan to each other's subsidiaries, when they give loan to each other subsidiaries, it is called what loan? Parallel loan. It is called parallel loan. Through parallel loan, they avoid conversion and reconversion. Through parallel loan, they avoid conversion and reconversion. Through parallel loan, they avoid conversion and reconversion, thereby eliminating what and what? Currency risk and spread. Thereby eliminating currency risk and spread. Everybody, are you following? Huh? See, transaction over here. They will give loan for how many dollars? Yeah, $5 lakh. Then this Japanese subsidiary will be repaying what? The $5 lakh along with what? 13% interest. For simplicity, in this sum they said that interest is not payable annually. It is payable after how many years? How many years loan here? 4 years. I am going to repay along with what? Interest. So like that same thing happens for what? The US subsidiary repays the money to the Japanese holding company in the same manner. Everybody have the clarity or not? No. This transaction is over here. Now, nobody will see who has gained, who has lost and done. This is not a speculation, only simply what? Hedging strategy. We don't look into whether exchange rate is in favor of them or say other party, etc. Only thing is the principle should be in what term? Equivalent term. One should be, I just forgot that now. Write down. Next. One point I forgot. Same thing you just continue writing. In parallel loan. Same point, second point, continue. One more line, that's all. In parallel loan, the principal should be in equivalent terms at spot rate. The principal should be in equivalent terms at spot rate. The principal should be in equivalent terms at spot rate. The principal should be in equivalent terms at spot rate. Should be in equivalent terms at spot rate. Did you follow or not? Next. Let me come back to discussion. But now, people wanted to just see post-mortem, everything over. Which party is better off in what? Parallel loan arrangement. They wanted to discuss after 4 years. At the end of 4 years, when everything is over, we did not have any work. Okay. So what we did, we took the papers and did some calculation to check who has gained or who has what lost in this parallel loan arrangement. Understand, basically nobody gains, nobody loses. They are only eliminating what? Exchange rate risk. But ultimately, on a same set of loan transaction, they'll be paying two different interests and also different exchange rates or not. Now, suppose they want to compare the ultimate repayment, ultimate what? Repayment between the two companies and see who is better off in what? The parallel loan arrangement after 4 years. Just we are doing a post-mortem exercise to understand something about the parallel loan transaction to take our discussion to the next stage in currency system. Can I start or not? Okay, now the question is as follows. Now read the question here. If the expectation proved to be correct, what is the expectation? Today, $1 is equal to 140 yen or not? Yes, and we expect that every year the dollar is going to appreciate or depreciate. So, about dollar is going to appreciate, depreciate, depreciate. Depreciate at what? 5 yen. And how many yen here? 5 yen. Upon over 4 years, what is the loss in yen? 20. About $1 will become how many yen? 120 yen at the end of 4 years or not? If this expectation happens, if the expectation what? Proves to be right, is the question back. If these expectations prove to be correct, what will be the dollar equivalent of principal and interest payment of Yasufuku at the end of what? 4 years. We just want to know, they repay in yen only, but what is the dollar equivalent is what you have to understand. Is the first question. Can I say? What total dollars will McDonald's receive at the end of 4 years? Is the second question. Principal and interest. Which party is better off in this parallel loan arrangement? These are the 3 questions we are going to answer. Can I start or not? No. We'll do it together. Part A. Write down Part A. Part A. Part A. Equivalent dollar realization. Equivalent dollar realization. Equivalent dollar realization by Yasufuku. That's the name here. Equivalent dollar realization by Yasufuku. From. They will laugh when they hear my name Rajagopal. Equivalent dollar realization by Yasufuku from McDonald's subsidiary. From McDonald's subsidiary. Equivalent dollar realization by Yasufuku from McDonald's subsidiary. From McDonald's subsidiary. Can I proceed? No. First of all, please answer my question. The McDonald's subsidiary repays money or not? It will repay in dollar or yen. It has to repay only 70 million yen along with the 4 years interest. Along with the 4 years interest compounded what? Annually. Can I proceed? Right on? One by one. Right, first. Maturity value in yen. Maturity value in yen. Maturity value in yen is equal to yen 7 crores. 700 00 maturity value in yen 7 crores into, tell me, the subsidy has to pay how much interest? 1.101 power what? 4. 7 crores into 1.10 power 4 is equal to yen. Solupa 1.10 power 4. 1.10 power 2 power 4 into 700 00. What the number please? 10 crores 24 lakhs 87,000. Yes or no? 10 crores 24 lakhs 87,000 is what? Are you listening? This is what the Yasufuku will be getting as what? Loan repayment from McDonald's US subsidiary, McDonald's subsidiary in Japan. Yes or no? Now, the transaction, that's all. Nobody converts and what? Reconverts. For us, what inquisitiveness, who has gained? We want to make fight with each other. Okay, so want to know who has what? Gained. I want to convert this into equivalent dollars. If this is dollars, now how much would it be? Question arises now. Now tell me, I am going to convert into equivalent dollars at spot rate prevailing at the end of 4th year. End of 4th year. Write down. Next, maturity value in equivalent dollars. Maturity value in equivalent dollars. Maturity value in equivalent dollar. Please again I say, nobody converts. Yeah, it is only to avoid conversion transaction take place. But the Yasufuku wants to make a small calculation looking at the newspaper. Okay, we got so much in or not. Had I converted into dollar today, what would I got as dollar? I want to have an equivalent dollar. So tell in maturity value in equivalent dollar is what? Yen what? 10 crores 24 lakh 87,000 divided by what is the rate? 120. I think I need not show you the calculation how it got 120 because depreciate at 5 yen per annum for how many years here? 4 years. Divided by 120. Now tell me the number please. Divided by what? 120. How many dollars? 8,54,058 is equal to dollar 8,54,058. So I would have got so much as what? Equivalent dollar realization from the McDonald's subsidiary. Response is or not? No. This part A has been completed. Tell me, are you following or not? No. I am just answering the question which has been asked here. What is the question here? If the expectation proved to be what? Correct. What will be the dollar equivalent of principal and interest payment to Yasufuku at the end of what? 4 years. This is what has been calculated. Please tell me, are you following up? No. Next, second question is, this company has given loan to Japanese subsidiary or not? They should repay in yen or dollars or dollar. They should repay only 5 lakhs or more than 5 lakhs or more than 5 lakhs. Along with what? 13% interest. It will be in dollar only. Enna right or not? Next, part A or part B? Part B. Maturity value of part B. Maturity value of loan given by McDonald's. Maturity value of loan given by McDonald's to Yasufuku subsidiary. Maturity value of loan given by McDonald's to Yasufuku's subsidiary. What to do here? To Y's subsidiary. To what? Y's subsidiary. Can I proceed or not? Come back. See, maturity value is equal to maturity value. Don't talk. Maturity value is equal to how many dollars? 5 lakhs into 1.13 into 1.13 power 4. 5 lakhs into 1.13 power 4. Tell me how much amount here? Your problem 1.13 power 2 power 4 into how much? 5 lakhs. 8,15,000 dollar, 8,15,237. Don't rush. 8,15,237. See, now tell me, if all this happens, who is better off through this parallel loan arrangement? The Yasufuku company, McDonald's. Yasufuku is able to realize what? 8,50,000 equivalent dollars of what? Loan back. But they are able to realize only what? 8,15,000. So tell me, who is better off with this parallel loan arrangement at the end of fourth year? Yasufuku. Yes or no? Write down. Next. Part B or part C? Part C. Write down part C. That's a question that has been asked. What is part C question? Which party is better off with the parallel loan arrangement? What would happen if the n did not change in value? Write down part C. Comparison. Part C. Give the heading comparison. Part C. Comparison. Point A. If the expectations proves correct, if the expectation proves correct, then Yasufuku, then Y is, you are not allowing to open any word. Next time I have to change your question here, okay? No. You are the first batch doing all these things. Don't. Flow away, Gane. What I dictate, Sulupa. Okay, now, Sulupa, what I dictated. If the expectation proves correct, then Yasufuku is better than. Then Yasufuku is better off than McDonald's. Then Y is better off than McDonald's. Y is better off than McDonald's in this loan arrangement. Then Y is better than McDonald's in this loan arrangement. Y is better off than McDonald's in this loan arrangement as they realize more dollar equivalent maturity value. 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 This is point A. Everybody yes or no? The two questions. What if the exchange rate does not change? Spot rate $1 is equal to 140 yen or not? After 4 years also, if a dollar is remaining what? 140 yen. MTH share price. After 4 years also, $1 is equal to what? 140 yen. Now tell me what is going to happen in the next issue. Write down point A or point B? Point B. If the exchange rate didn't change, if the exchange rate does not change, then after 4 years, the dollar equivalent, maturity value realization, the dollar equivalent maturity value realization by Yasufuku is, then the dollar equivalent maturity value realization by Yasufuku is, tell me the calculation is, what divided by what? N 10 crores 24 lakh 87,000 divided by N 10 crores 24 lakh 87,000 divided by what? 140. 10 crore 24 divided by 140 is equal to how much? $7,32,050. $7,32,050. $7,32,050. $7,32,050. In this case, can you write it? In this case, can you all tell me who is better off with this loan arrangement? McDonald's or Yasufuku? McDonald's. They are having what? 8,15,000. In this case, McDonald's is better off. In this case, McDonald's is better off with the loan arrangement. In this case, McDonald's is better off with the loan arrangement. McDonald's is better off with the loan arrangement. With the loan arrangement. Up to this, everybody, are you all having the clarity or not? Now let us discuss a small concept known to you only and then conclude this sum. Okay, now listen. Shh. Now, shh. See, US company $5 lakh loan carries 13% interest rate. But Japanese company charges only how much interest rate? 10%. If you look at it prima facie, US companies start with an advantage because they are charging more interest and they are charging what? Less interest for the same principle. Why same principle? Means this $5 lakh spotted is same as what? 7 crore yen. Okay. Principle being same. Listening, principle being same, US company is charging what? More interest and Japanese company charging what? Less interest. Are you listening under what I am saying? So in that case, who start with an advantage naturally? US company having more interest start with what? Advantage. We all have seen that the advantage cannot be sustained because company having high interest will have its currency weakened. We discussed in IRPT number company having what? High interest will be having what? Weak currency. Weak currency, dollar becomes what? Weak. If a dollar can buy 140 yen today, the same dollar can buy only what? Lesser than tomorrow. Can I say it? Now, even though I realize a high dollar maturity value, suppose I want to convert into yen, it will be going into what? A lesser value because a dollar can buy only what? Lesser yen. It can be vice versa here also. This company is having a low interest rate or not? The country having low interest will be having what? Premium on its currency. The interest rate plus premium compensate for what? Other country. Yes, adjusted foreign currency interest rate is equal to local interest rate plus premium. No. Same thing. So country having low interest rate will be having a premium currency. Country having high interest rate will be having what? Discount currency. The premium or discount brings a parity in the interest rate. Don't think that it is having an advantage at what? 13%. It is having advantage in interest. Having disadvantage in what? Currency because it is going to realize a weaker dollar. What I am saying. But they have a disadvantage in what? Interest. The advantage is going to get what? A stronger yen which can buy what? More dollars. Are you having clarity what I am discussing? So this is what we should be understanding first. So country having high interest rate need not have an advantage per se because the currency should be trading at what? Weaker value. So that is compensated by the discount on its currency and so on. Up to this discussion. Yes, now. See, what happened is, if the yen did not change, or the dollar did not what? Change. Now also $1, 140 yen. After 4 years also $1 is how much? 140 yen. Listening. In that case, currency neither gained nor loses. Appo, who is at an advantage? US. They received a higher interest rate 13%. If the dollar did not depreciate, not did not what? Depreciate. Or otherwise, yen did not what? Appreciate. Then US company is happy because the currency is intact. It has not what? Lost in value and still they are earning what? High interest. That is why the US company is well off in the second case when the yen did not change. Yen did not what? Change. When yen changed by, that is when dollar changed by 5 yen per year to what? 120. To what? 120. What happened is the loss in dollar value, the gain in what? Yen value superseded the 3% interest. That is why the Japanese company is what? Advantage. Japanese company had a lower 10% interest only. Understood? But what happened is today a dollar was 140 yen. After how many years? 4 years. The dollar became what? 120 yen. So this yen gets converted into more number of dollars. What I am saying. So the depreciation in the currency was able to convert into more number of dollars compared to the lossy interest rate. So the Japanese company is what? At an advantage. Yes or no? So if the dollar did not change, US company is having advantage due to what? Interest rate. If the dollar depreciated very much, depreciated what? Very much to 120, who is advantage? Yes, Japanese company. At some rate, both should be equally good now. At some rate, both should be what? Equally good. What rate? IRPT. It is what idea? IR. When the exchange rate after 4 years is as per what? IRPT. Then exactly the loss of dollar value compensates for what? The extra interest in what? Dollars. And both will be equally well off in what? The loan transaction. So when I enter into any currency swap or parallel loans and all, we expect an IRPT to what happen, and then only enter. If the IRPT is not happening, then what happens? One party may end up with a gain, other will want a loss also. In a say back of the envelope calculation. Everybody has the clarity about. That's what I just wanted to discuss. Okay, and the fourth question that I asked here, that is the question I added, not in the original question. What is question number 4? Calculate the break-even maturity future spot. Is it $1 is equal to 140 enna, 120 enna, IRPT? IRPT is a break-even maturity spot at which both companies will be having what? Same equivalent maturity value. Did you understand my discussion? Yes, shall I proceed further? Next. Part C, part D. Write down part D. Part D. Don't talk, please. Part D. Break-even maturity futures, break-even maturity futures spot trade. Break-even maturity futures spot trade. Break-even maturity futures spot trade. Shall I proceed now? Write down. In that right, point A. Point A. Advantage to the US company is that. Advantage to the US company is that it receives. Advantage to the US company is that it receives. Can you fill up? It receives what? It receives higher interest. Advantage to the US company is that it receives higher interest. Point B. Country having higher interest. Country having higher interest will have weak currency. Country having higher interest will have weak currency. And the advantage to Japanese company is, and the advantage to Japanese company is that it will receive, an advantage to Japanese company is that it will receive a stronger yen as a maturity value. It will receive a stronger yen as a maturity value. It will receive a stronger yen as a maturity value. Romba simple, $1, 140 yen today, it becomes 120 yen, yen has become stronger, dollars become what? Weaker. It will receive a strong, what I said, advantage of Japanese company is that it will receive stronger yen as the maturity value, which gets converted into higher dollars. Which gets converted into higher dollars. Or more dollars. Which gets converted into more dollars. Which gets converted into more dollars. Which gets converted into more dollars. Did you follow or not? Next. Point B or point C? Point C. We have seen two situations. We have seen two situations. Branch it into two. First branch, exchange rate did not change. Exchange rate did not change. Second branch, dollar depreciated. Second branch, dollar depreciated drastically. Dollar depreciated drastically. That is from 140 depreciated to what? 120. Dollar depreciated drastically. First branch, put a down mark and write, US company had advantage. US company had advantage because of. US company had advantage because of what? Higher interest. US company had advantage because of higher interest. Second branch, tell me who had advantage? Japanese company had advantage. Japanese company had advantage because of what? Stronger yen. We can say weaker dollar or what? Stronger yen. Both ways can say Japanese company had advantage because of what? Stronger yen or weaker dollar. Had advantage of stronger yen or weaker dollar. Japanese company had advantage of stronger yen or weaker dollar. So did you understand the two situations or not? Next. Point soluba B or C? Point D. The exchange rate at which both companies have equal maturity value. The exchange rate at which both companies have equal maturity value is called. The exchange rate at which both companies have equal maturity value is called what? Break-even is called break-even future spot rate. And maturity future both are same. Is called break-even future spot rate, which is nothing but what? IRPT forward. Which is nothing but IRPT forward. Do you understand the notes up to this? It's nothing but IRPT forward. Last point. Point B, C, D. Okay, point E. Right. IRPT forward. Point E. IRPT forward. Spot rate. What is spot rate here? $1 is equal to yen 140. $1 is equal to yen 140. We all know interest rate parity formula. What is the formula? Forward rate is equal to what? Spot rate into 1 plus home currency interest rate power yen divided by 1 plus foreign currency interest rate power yen. This is continuous compounding. What is the formula? What the formula it is? Forward rate is equal to spot rate into e power t into home currency interest rate minus foreign currency interest rate. Okay, can I proceed further? No. Which is equal to, write down, forward rate is equal to spot rate into 1 plus RHC. RHC means what? Home currency interest rate power n divided by 1 plus RFC. That means what? Foreign currency interest rate power n. Spot rate into 1 plus home currency interest rate power n divided by 1 plus foreign currency interest rate power n. I want an answer. Are you following? Yes, sir. Next, substitute that number here. Forward rate is equal to, spot rate is 140. Yes, 140 into 1 point. What is a home currency interest rate? So what is the home currency interest rate? 1.1 0. $1 is equal to how many yen? Is the issue now. So 1.10 power what? 4 divided by 1.13 power 4. 1.10 power 4 divided by 1.13 power 4. $1 is equal to, calculate and tell me, 140 into 1.10 power 4 divided by 1.13 power 4. Number please. 125.71 yen. 125.71 yen. 125.71 yen. If you are finding this formula confusing, romba simple here. $1 is equal to 140 yen. Dollar compounds at 1.13 power 4. Yen compound as what? 1.10. So 140 into 1.10 power 4. Romba simple. After from what happens here? $1 into 1.13 power 4 is equal to what? 140 into 1.10 power 4. So $1 should be equal to what? 140 into 1.10 power 4 divided by what? 1.13 power 4. Are you following the discussion or not? No. How much you want to get? 125.71. Right now, next. Point F. If the exchange rate happens to be IRPT forward. Point F. If the exchange rate happens to be IRPT forward. if the exchange rate happens to be IRPT forward. Then the dollar equivalent maturity value for Yasufuku is, then the dollar equivalent maturity value for Yasufuku is, then the dollar equivalent maturity value for Yasufuku is, tell me the number, it is how much? 10 crores? 27 lakhs, 24 lakhs, 87,000 divided by how much? 125.71. 10 crores, 24 lakh, 87,000 divided by 125.71. Number please. 8,15,000. 8,15,265 dollars. 8,15,265 dollars. Which is same as, don't argue with me that is 8 lakh, how much? 15,000. 237, 3765. Don't think that the difference is there. The tips can I say? So it is same as McDonald's dollar realization, which is same as McDonald's dollar realization, which is same as McDonald's dollar realization, which is same as McDonald's dollar realization. Now this question number 9, are you having the clarity or not? Okay. This, if we make it only a formal arrangement, it becomes what? Currency swaps. Now, I just wanted to drive home the importance of the IRPT through this particular transaction. Now, can you start with the formal currency swap problems or not? No. Let us start discussing about currency swap with the help of question number 1. Don't touch. See, question number 1, no need to write the solution, printed and given. Only work for you should draw a small flow diagram which you can draw after I start the solution. Please. Shh. All others with full explanation has been given in the notes. Okay. Question number 1 is not so big. But using that question, so many concepts have been explained. It is going to be the trend setter for the remaining problems to follow. Please. Stop. Shh. Shall we start? Please. For concentration, focus here. Please, you have to complete the portions. Please take question number 1. Please, IBM and British Petroleum entered into currency swap agreement on 1st February, where IBM will pay 11% interest on a notional principal of pound 10 million in exchange for a dollar interest of 8% on a notional principal of $15 million. The swap takes place annually for a term of 5 years. Write the swap cash flow from IBM's point of view. This is the question which has been given. Please help. Don't talk, have focus. Don't say sideline the discussion here. Don't make me control you. And every time I lose, I will not be able to get back because only 2 more classes left to complete the portions. Yeah, correct? Shall I start? Okay, see. There is a currency swap transaction taking place between 2 parties. Name the two parties, IBM and then BP. Obviously, we know that IBM is a US based company and British Petroleum is UK based company. These two companies are entering into what? A currency swap agreement. Can I proceed or not? What is a currency swap agreement? Agreement is IBM will be swapping. See the question. So where IBM will pay what? 11% interest on a pound 10 million notional principal. So IBM is going to pay pound interest or dollar interest or pound interest. A company paying pound interest has issued a pound bond. Like that, can you imagine or not? So IBM will be receiving a notional principal of 10 million pound on which it is going to pay what? An interest of pound 11%. Everybody yes or no? Rumba careful listen pa. It is looking similar to interest rate swap, but some nuances are involved in this currency swap. Can I say it? Now, same way, British Petroleum wants to pay, in the swap is going to what? Pay. They're going to pay what interest? $8 interest on raising a dollar bond. How much here? $15 million. And how much percent interest? 8% interest. Idamba swap transaction has taken place. What this means, what has been done will be the subject matter discussion in the next area. I will have the full clarity up to this or not? Should I explain once again? Or can we proceed? Okay. Once again, I'll just tell you. Rumba simple. A swap has taken place between two companies, namely what? IBM, British. Where IBM is going to pay what? 11% pound interest in receipt of what? 8% dollar interest. This 11% pound interest is on a notional loan of how much lakhs? How many million? Pound 10 million. That is why the money is coming back now, raising now inflow for IBM. Like that, it is going to receive 8% interest on a notional deposit made how much million? $15 million. What I am saying. So when I receive interest, I am going to deposit dollars. When I pay interest, I am going to what? Raise pounds. Is what one should be understanding through this transaction. Those two principles are called as what? Notional principle, because they need not be exchanged, because at spot rate the $10 million is equal to what? 10 million pound is equal to what? $15 million. You know what the amount is going to remain what? Same only. This is the primary transaction. Everybody yes or no? Please copy this flow diagram alone in the sheet. Okay. I think page number what in your classroom notes here? 260. Page number 260. In that you can just draw this diagram quickly. Very small diagram. From there we'll take our discussion forward. Please. Finished now. Finish copying. Shall we start up? Now all of you listen, please. Shh. Just 10 minutes will complete our discussion. See, this is also an interest rate swap. We are exchanging what? Two interest rate. We are exchanging a pound interest rate against what? Dollar interest rate. There we exchange LIBOR against a fixed rate. Here we exchange what? A pound interest rate against what? Dollar interest rate. Point number one. Yes or no? Simply we are swapping two interest rates. Okay. Now, let us see the procedure one by one. Number one. Today IBM and British Petroleum enter into currency swap or not? Yes, sir. My question is, should IBM give $50 million and should British Petroleum give 10 million pounds? Question number one. Did I answer the question or not? That is, should the notional principal be exchanged today? What? Yes or no? No need to exchange what? Notional principal, because ultimately nothing happens here. Today $1 is equal to £1 is equal to $1.5. What? What happens is, I'll be taking dollars, buying pound and giving. He'll give me what? Dollars back. It's going to remain what? Same only. Since we are exchanging an equivalent principal today, the principal need not be what? Physically exchanged. That's why I call it as a notional principal. What principal here? Notional principal. Everybody agreed or not? Yes. If the party decides to exchange, the party what? Decides to exchange for some other requirements, then they can exchange. Or if what I am saying, that is exchanging or not will not change the transaction. If the party says, I want the principal to be what? Exchange. I want pounds. I want dollar for some other purpose. Now, currency swaps are used only for some hedging purpose. Okay. If the party wants now in the agreement they should specify, then the initial principal should be what? Exchange. Otherwise, basically, no need to exchange what? 10 million pound with what? $15 million. I need not give you 10 million pound, nor you need to give me what? $50 million. We need not exchange notional because they both are what? Equivalent. Point number one, everybody, yes or no? Okay. How many years swap? 5 years. Okay. Now, today we signed the swap agreement. Nothing needs to be done. Just agreement has been what? Signed. We need not exchange what? Principal. Same thing happened in interest rate swap also. In interest rate swap, is a principal exchanging hands? No. We call it, that is why we call it what principal? Notional principal. Its only role is to apply the rate and what? Calculate the interest. Point number one, agreed or not? Okay. Today, we just signed the agreement. Nothing is to be done. Every year, interest are going to be exchanged or not? Each year, interest is going to be what? Exchange. How many years? 5 years. In the swap. Okay. In a normal interest rate swap, we exchange LIBOR against 6%. LIBOR against what percentage? 6%. Suppose LIBOR becomes 7%. Person receiving LIBOR will receive 7 and pay what? 6. Will he receive 7 and pay 6 or knock off and say receive 1%? We knock off the interest and receive what? That is, interest is not going to be exchanged. The interest is what? Netted off, and the net amount only will be what? Exchange. The gain or loss only is exchanged in a currency, in a interest rate swap. Did you follow what I am saying? That is, LIBOR becomes 4% here. 4% receive pay what? 6%. Now, they will be paying net what? 2% to other party. So, interest rate swap, like interest is not exchange. The interest is what? Knocked off. LIBOR is knocked off against what? The given fixed rate on the given reset date, and the net amount only is what? Exchange. But like that you should not do in currency swap, because the 11% pound interest should not be net off against what? 8%, because every reset day the exchange rate also changes now. The exchange also what? Changes. So we should not do the mistake of knocking off what? 11% again 8%. Currency swap alone, the interest flows fully. Interest flows what? Fully. IBM will give a check to BP. How much? 11%. It will pay what? 11% interest. British pound will give a check to what? IBM. How much percent interest? 8%. In other words, IBM is a US company now. It has to take dollars out of its pocket, go to the bank, buy pound and pay what? 11% interest. British Petroleum is a UK company or not. You may having pounds in the pocket, take pound out of the pocket, go to the bank, buy what? Dollars and pay what? 8% interest. Nobody can knock off the interest. Interest cannot be what? Knocked off, because it is two different currencies. Interest cannot be what? LIBOR against 6%, LIBOR and 6 both are in rupees only. Both are in what? Dollars. These are two different currencies. So in a currency swap, interest flows what? Fully. The IBM pays 11% pound interest and also receives what? 8% dollar interest. Same thing happens for what? The British Petroleum also. Point number 2. Everybody, I have clarity enough. I am now telling you the cash flows. Year 0, today, any cash flow, no cash flow, no cash flow. Notional principal need not be what? Exchange. Because 10 million pound is same as what? $15 million. And a spot rate is what? 1.5. So there is no need to exchange what? Principal. It is going to result in zero cash flow only ultimately. So no. But however, Every year when the interests are going to be swapped, interest are going to be what? Swapped. The interest is fully swapped and not the gain alone is what? Settled or what? Received. So we have to pay the full 11% pound interest and receive what? 8%. The same thing opposite for what? British Petroleum. Interest should flow what? Fully. Don't do the mistake of what? Knocking off interest because they cannot be what? Knocked off. Is point number 2. Everybody agreeing it or not? No. Next. On the last date. On what date? 5th year. That is on what? 5th year. Now tell me, should the notional principal be exchanged? Need more exchange? Should be exchanged because after 5 years, 10 million pound need not be equal to what? $50 million because it's not a spot rate. It will become future spot rate or not? Now today we can say 10 million pound is equal to what? $50 million. At the end of 5 years, in currency swap, principal should be what? Exchange. We need not do so in interest rate swap. In interest rate swap, the notional principal is neither received nor paid. The reason is what? Very simple. It is the same amount. We can just strike it off. Yes or no? But here, I need not exchange the notional principal at the beginning because both are equal in value. But I should compulsorily what? Exchange towards what? Last year because at that time $1 need not be equal to what? So 1 pound need not be equal to what? $1.5. So in this case, you have to fully exchange what? The notional principal towards what? The end of the swap agreement. This one have the clarity as well. Did you follow what I am discussing or not? So first I told you now about the transaction that will happen in what? Currency swap. Now can you all tell me the difference between currency swap and interest rate swap? Two differences. In interest rate swap, interests are knocked off. Floating against fixed is what? Knocked off. Net interest is settled. Yes or no? In this case, interest cannot be knocked off. Pay fully and receive what? Fully. Last year, principal need not be paid or received. In case of what swap? Interest rate swap. Here we have to want pay and receive what? The notional principal amount because the exchange rate is going to be what? Different in the last year. So this is another change between what? A currency swap and the interest rate swap. Up to this, having the full clarity. Yes, can I go to the next stage of discussion now? No. I am just building up that discussion. It may be helpful in the swap valuation later. Okay. Now, see. We'll continue the discussion with the help of the notes given. Okay. Flow diagram finished now? Okay. Now, I want to discuss something around how many points? 10 points. Okay. See, we are discussing about 2 to 3 points. In currency swap transaction, IBM has agreed to pay what? 11% interest on notional principal of 10 million pounds in exchange for what? 8% interest on a notional principal of 15 million pounds. First point, agreed or not? Next. The notional principal should be same in equivalent terms at spot exchange rate at the time of swap initiation. Then only swap will start with a zero value. Can I proceed or not? Next. At the time of swap initiation, the notional principal need not be exchanged but can be exchanged if the agreement requires it to be exchanged. It is choice only, not what? Compulsion. Unlike interest rate swap, interest cannot be netted off and settled. Full interest should be exchanged on each settlement date as they belong to different currencies. In the last or which year? 5th year. The notional principal should be compulsorily exchanged. No choice, should be compulsorily exchanged because we cannot say on the maturity date that $50 million is equal to what? 10 million pound, as the exchange would have what? Changed up to point number 5. Are you have the clarity or not? Okay, some typing mistake is there in point number 6. Let us correct it. Okay, point number 6. Swap cash flow from whose point of view? IBM's point of view. I'll just draw the diagram also myself. So look, for the two parties, IBM and then what? British Petroleum. Okay, IBM is going to receive is going to receive what? Pound 10 million to pay how much interest? Pound 11% interest. It is going to deposit $10 million, $50 million, sorry. Okay, receive how much percent interest? 8%. Just for me to see. Can I proceed? Now, see here. Let us discuss on IBM viewpoint. Opposite for what? British Petroleum. I need not discuss on both the sides. Yes or no? Let's see from the IBM's viewpoint. Very important here. Listen here. Now, IBM will be having for the 5 years cash flows in two currencies due to SAP. One is what? Dollar cash flow. And is what? Pound cash flow. Are you listening? Now, imagine that initial principle is exchange for you to understand much more better. Okay. Now, IBM has invested $50 million or not. Something similar to deposit in what? A dollar denominator bond. Can I say it? So IBM has invested what? $15 million. Inflow, outflow, outflow. So today year 0. First of all, are you listening? Today year 0, IBM has given to British Petroleum how many dollars? $15 million. Imagine it's going to be exchanged. Can I say it? Now, for this, it is going to receive from British Petroleum how many years? 5 years. How much percent interest? 8%. So what is 8% interest on $50 million? 1.2 million. So 1.2 million, correct? 1.2 million, 1.2 million, 1.2 million, 1.2 million. Going to see for what? 5 years. The spot is on. Now, 5th year, tell me, should the principal be compulsory exchange? Yes. So now the British Petroleum will be repaying back what? 15 million. Repaying about $15 million. So IBM is going to pay a receiver, receive. So this is a dollar cash flow. This is a home currency cash flow for what? IBM. So what they have done is, I completed this particular leg. IBM gave $50 million to what? British Petroleum and received what? 8%, 8%, 8%, 8%. How many years? 5 years. $1.2 million. 5th year received back what? $15 million. This happened to IBM. In my son, no. Like that, IBM has got pound cash flow or not? It received today how much pound? How much pound? 10 million pound. And it has to pay every how much interest? 11% on what? 10 million. That's a typing mistake. Write these numbers in what? Brackets. And these are all inflows, outflows, outflows. Please, that's a typing mistake. Write these numbers in what? Brackets. Forgot to be typed. Can I proceed or not? Now, so IBM received 10 million pound today as a notion principal and paid how much interest? 11%. 11% means what? 1.1 million, 1.1 million, 1.1 million, 1.1 million, 1.1 million. Then what? 10 million. Respond is or no? Now, the last day, since it has received what? Repay. Everybody are you having the clarity? Okay. This cash flow, did you understand? Should I repeat? Should I repeat? Repeat or proceed? The proceed na, don't talk. Repeat. Anybody want to repeat now? So repeat. Yes, repeat. No, na ketana. Yes, alone tell me. Repeat. I heard yes. Okay, Azam. Don't touch. Start up. Please, don't drag the class, please. Then you are the family. Okay, don't drag the class, etc. Can I say? See, ரொம்ப simple. Two legs are happening. You tell me for IBM. IBM, please, is now investing 15, it is exchanging now. It is now investing what? $15 million with British Petroleum and getting what? 8% interest. Year 0 outflow 15 million and getting what? $1.2 million what? Every year for how many years? 5 years. Last 5th year, he'll get back the money or not? Yes. He'll be getting back what? $15 million. Is a dollar cash flow. Please tell me, are you following? Yes. And same IBM is having another cash also called as what? Pound. It is now raising what? 10 million pound and paying what? 11% interest. So today 10 million pound is what? Inflow. And each year pay how much? 11% and 10 million. 1.1 million pound as what? Outflow. Last year to repay this, it becomes what? Outflow. So this is what I have written in what? The cash flow still now. Everybody are you have the clarity? Yes, sir. One thing here. This alone is 0 because today $1, 1 pound is equal to $1.5 or not? Super. Yes, simple. What happens is I am going to get 10 million pound or not? Yes, receive 10 million pound, convert it into 1.5. How many days? $15 million and give it back to him. Yeah. You give me 10 million pound. What I do? I take the 10 million pound, go to the bank, convert it into what? $15 million and give it back. What you will do? You will receive $15 million, convert it into what? 10 million pound. So neither cash flow for you nor cash flow what? For me. It becomes zero this alone. But we cannot say this for what? All the remaining cash flow. That is why this alone may be exchanged, may not be exchanged. Exchanging or not exchanging will not affect my what? Swap cash flow, because this is on what terms? Equivalent terms. Do you follow what I am saying or not? Now, suppose you are British Petroleum or what? British Petroleum. Tell me what happens today. Today you have to give me what? 10 million pounds and you'll be getting back what? $15 million. You will convert into what? 10 million pounds and keep it home. So what I am saying, in this case, this is going to be not a cash flow at all. The remaining only happens to be what? Cash flow. Everybody, yes or no? Okay, now see. Now we are seeing cash flows for IBM. Nah? Okay. What the home currency for IBM? Home currency is what? Dollars. Okay. Now every year, this is not a problem. It is in dollars only. But these cash flows are in what? Pounds. I should pay dollars to buy these pounds or not? So first year I have to buy this 1.1 million pound to be settled here. This I buy at what? The spot rate existing after 1 year. After 1 year. This I want to buy a rate existing after what? 2 years. So in all this case, I have to take the dollars, pay the dollars, convert into what? Pound, and then what? Settle. So there's going to be a conversion happening in this case. Yes or no? Yes, now, suppose the pound rates after 1 year, 2 years, 3 years, 4 years, 5 years happens to be IRPT. Other discussion. Listening now. Suppose I am able to convert at what forward rate? IRPT. The real rate on those dates happens to be what rate? IRPT. Let's see what is going to happen in this chapter. What is going to happen in this one? For that we have to first calculate IRPT forward or not. IRPT forward have calculate or not? Now all of you tell me the calculation of IRPT forward. Now I am the US company called as what? IBM. For me spot rate is 1 pound is equal to $1.5 or not? Yes, Rumba simple. First let me calculate 1 year forward. What forward here? 1 year forward. This 1 pound grows at how much percent? 11%. Yes, how much percent? How much percent? 11% is equal to this $1.5 goes at what percent? 8%. So what happens here? 1 pound is equal to $1.5 into what? 1.08 power 1 divided by what? 1.11 power 1. Enna clarity irukka? You will be getting some number. Now, ore number. So what is the number, please? What is the number, please? $1.45 4595. 4595. Suppose you tell me what is the second year rate? 1 pound is equal to what? $1.5 into 1.08 power 2 divided by what? 1.11 power 2. In the clarity, yes or no? Like that, can't we calculate IRPT forward for the 5 years or not? That's what I done in the next step here. Point number 6 over now. Swap cash flows for what? IBM written. Now I am going to calculate the IRPT forward. Year 0, 1 pound is equal to $1.5. So what is the exchange rate here? $1.5. Yes or no? Year 1, 1 pound is equal to $1.5 into 1.08 power 1 divided by what? 1.11 power 1. There may be some typing mistake. Check and tell me. You have to check and tell me. Yesterday somebody said in the farewell, check. Like that what? Check and tell me. So what is the number, please? There may be mistakes, please. Understand what number? 1.459. I ask a question here. Pound is strengthening or weakening? But in a bulb, please stop. Pound is strengthening or weakening? Tell me why the pound is weakening. Because pound is having a higher interest rate. The currency what? Weakens. Dollar strengthens, pound what? Weakens. Next step. 1 pound is equal to 1.5 into 1.08 square divided by what? 1.11 square. Tell me what is the number? 1.4200. That may be typing mistake. I'm really saying. Okay. 1 pound is equal to $1.5 into 1.08 cube divided by 1. This number you take into 1.08 divided by 1.11. Can I present what is the number, please? 1.3816. 1 pound is equal to 1.5 into 1.08 power 4 divided by 1.11 power 4 gives how much? 1.3443. News party padikada. Can I say? No. 1 pound is equal to 1.08 power 5 divided by 1.11 power 5 into how much number? 1.3080. Now, see, these are all the forward rates as per what? IRPT. As per expectation theory, suppose these rates proves to be the real rate after 1 year, 2 year, etc. Okay. When I go to convert after 1 year, this happens to be what? Rate now. Then my actual rates are same as what? IRPT rate. You know, Kadaba? IFM we discuss going to be no covered interest arbitration. Now, in this case, let us see what is going to happen. Now, shall I proceed? Now, please. Conversion of IBM cash flows into home currency what? Dollars. I request here, can you start doing it together? First, year 0. Following up to this. Yes, another, without writing when I do, I have this problem. But let us complete this. Remaining will be writing and do it. Okay, first, year 0. Tell me the IBM cash flow. It receives what? $15 million as a swap inflow. Yes, it has to pay what? Sorry, it is going to pay $15 million. It is going to receive what? 10 million pounds. 10 million pounds will be converted into what? Dollars. And how many dollars? 1.5. What the inflow? 15 million. That is why I said no need to exchange because the cash flow is what? 0 in year 0. It's not what I'm saying. No. Year 1, it has to say receive dollar interest and pay what? Pound interest. Every year receive $1.2 million interest and pay what? 1.1 million pound interest. The dollar interest is 1.2 million. But 1.1 million pound, I should steal buy. I should buy by paying how many dollars per pound? 1.4595. So 1.5 million pound into what? 1.4595. So many dollars has to be what? Spent to buy this pound and settle the stock. So how much is the outflow here? 1.6055. Sollupa. Or you are calculating, huh? Okay. Now, I receive how much? 1.2 million. And I am going to pay what? 1.6055. Net cash flow in the first swap cash flow is dollar received or dollar payment. Dollar. How much dollar payment? Minus 0.4055. So this is my dollar outflow in the first swap cash flow. No. Second swap cash flow, please. I receive once again what? $1.2 million from the British Petroleum as the swap receipt. The swap payment is what? 1.1 million pound, which I'm going to convert at what exchange rate? 1.42. So, what is the amount? What's the amount here? What is the amount? It is $1.562 million is going to be what? Paid to purchase this pound. $1.2 million is what? Received. $1.562 million is what? Payment. Tell me what the net receipt here? Minus 0.362. Everybody, yes or no? Like this. Third case, it becomes minus 0.3198. Fourth case, minus 0.2787. All these are swap outflows for what? The IBM for the first 4 years. Yes or no? Now, fifth year, all of you listen. Fifth year, it has to receive the principal back $15 million. Yes, also receive swap interest how much? 1.2 million. So what the inflow? $16.2 million is what? Inflow. I want an answer. Yes or no? But it has to repay 10 million pound along with what? 1.1 million interest. What repayment here? 11.1 million into 1.3080 is what? The exchange rate. That gives you how much? 14.5188 million outflow. So this money gives you what? $1.6812. This is a swap cash flow in home currency for this IBM. If the interest rate happens to be, if the exchange happens to be what? As per IRPT, I want an answer. I have a doubt. Everybody understanding? Yes, if you want, we'll once again write in the notebook and discuss if you require, or is it enough? Can I proceed? No. Now, you are IBM. You are what? IBM. You have entered into currency swap. What swap here? Currency swap. But this is your swap transaction. Tell me, for this swap, you have to tell me your cash flow for the 5 years. Today, what is your cash flow? Nothing. No principal are equivalent. First year, what the cash flow? Minus $0.4055 million. Yes or no? What the second year? minus $0.362 million. Third year, minus $0.3198 million. Fourth year, minus $0.2787 million. Last year you got how much? $1.6812 million. So this is your swap cash flow provided. Provided what? IRPT forward happens to be what? The real forward. Is the point number 1. Yes or no? Now, if you want to know the net impact, can I add all these cash flows? Why? Time value of money is occurring in different points of time or not. So, discounted what rate? 8%. Why? Dollar calculated discounted what rate? Dollar rate. Can I proceed? So, in that case, I wrote all these cash flows. I wrote what? All these cash flows. Discount of what percent? 8%. So, present value of 8% today is what? 1. So, tell me 1 divided by 1.08 is equal to, what's the number? 9259 is equal to 0.8573 is equal to 0.7938 is equal to 0.7350 is equal to 0.6806. That's what I saw. Now, if I multiply this cash flows and then what? Add it, I'll be getting 0. About the swap starts equally. Swap starts what? Equally. Did you understand what I'm discussing or not? Solupa. That means if the actual exchange rates after what? That is every year in future happens to be what? IRPT. And provided the two countries' interest rate does not change. If interest rate next year becomes around 7%, I'll be discounting at what percent? 7%, then 6 and so on. If the interest rate remains what? Intact. And the exchange rate happens to be what? IRPT. Then if these plans are good, then the swap becomes what? Zero swap. If anything changes, one party gains, other party loses, then this currency swap can become a swap asset for one party, swap liability for one party, because it's nothing but exchange of two bonds here. Exchange of a home currency bond against what? Foreign currency bond is called as what? A currency swap. So as long as the interest rates and exchange rates are stagnant. Stagnant means what? Exchange is as per what? IRPT. Interest rate continues to be 11 against what? 8. Tomorrow the pound decreases to 6 and this is going to be what? 9. Then the entire swap becomes what? Ulta, and I'll be receiving and paying this, but the real interest is what? Different. The interest rates also should continue to be what? 11.8 and the exchange also to be what? IRPT. If that happens, the currency swap becomes what? A zero value swap. At the time of what? Signing the swap agreement, up to this everybody has the clarity or not? But in the future, as the swap progresses, if anyone changes either the exchange rate or the discount rate, called as what? Interest rate. If any one of them changes, then one party may become a gainer, other becomes what? A loser. It becomes a swap gain or swap loss, and we'll be having what? An asset and liability for one party and another. We'll discuss about it in the next class, possibly the swap valuation. Everybody up to this have the clarity or not? With this, I have introduced you to the concept called as what? Currency swap. Concept called as what? Currency swap. Everybody, yes or no? Okay. Now, is the basic transaction, which how I explained question number 1 in IRS na? Same how IRS had a question number 1, we had what? Question number 1 in what? Currency swap, where we understood basically what is currency swap. Now let's go for the next stage. Then we'll start in doing problem very quickly. All small sums only, because we already know the interest rate swap. Can I proceed or not? Okay. Now, before I proceed further, let me just consolidate and proceed. Solupa. Currency swap is the exchange of interest rate, floating fixed at two currency interest rates. Two currency interest rate. These interest rates are calculated on a notional principle. So, this notional principle should be equivalent. At what rate? Spot rate. Should we exchange notional principle today? No need. May or may not. But can we knock off the interest rate every year? No. Why? It is different exchange rates are going to be there. It cannot be what? Knocked off. Interest should be fully paid and received. Last year should the principal be exchanged or knocked off? Compulsorily exchanged. This is swap order meaning. Now, if these transactions, if we convert into your home currency, what currency? Home currency. If the IRPT rate happens to be a conversion rate, and interest rate did not change throughout what? 5-year period, continue to remain 11 against what? 8 in the open market also means, then the swap will end with what? Zero value, else it may become a swap asset on a swap liability between the two parties is a basic discussion. If you want to have confirmation, sir, how can I believe you? You can go home and do the same thing for BP. Do it for what? British Petroleum, where you will be having the pound cash flows and then what? Dollar cash flow. Convert the dollar cash flow into what? Pound, using the same IRPT rates only. Instead of multiplying divided by what? The number to get the converted pound. There also you will be getting what value? Zero value. You should be getting it. Everybody understand what I'm discussing or not? Now, some rounding off errors, leave it. You should be having only what value? Zero value. With this question number 1 has been what? Completed. Can I proceed? Next. See. This currency swap can be used as a tool to convert asset or liability in one currency into another currency. How? Yeah, asset or liability in floating can be converted into what? Fixed. And vice versa. Same way, your cash flows in one currency can be converted into what? Another currency using what? Currency swap. That is, we have something called a touchstone. That is, if there is a metal, yeah, there's a touchstone. If you touch that with the metal, it will become gold or not. Can I say, now listen, leave it here. Like that, when I touch the currencies with a dollar cash flow, it becomes what? A pound. Pound to dollar becomes what? Easily. Without changing the original transaction, I can change the nature of the cash flow from what? Pound to dollars or dollar to pound using what? Currency swap. So currency swap has got the ability to transform an asset of one currency into what? Another currency, or liability of one currency into what? Another currency. How it can be done, we'll be seeing through the flow diagram. How it is interest rate swap in the next two sums. Can I start or not? Once it is done, we'll discuss how we can have an arbitrage. We have the arbitrage in interest rate swap or not? Using the comparative advantage of interest rates, how can have what? The currency swap arbitrage will be what? The next subject matter of discussion. Last, we'll see how the currency swap should be what? Valued as the swap progresses into swap asset and what? Swap liability. No need to find a fixed rate leg and all, because two countries' currencies are daily quoted against each other or not. US interest rate and India interest rate, we know today. Yeah, today we have a Libor, we have what? A Mibor also. That can be used as an exchange rate. Okay, in fixing this 11 against 8, no need to do any great calculation. In today at spot, US interest rate is what? 8%. UK is what? 11%. For this like floating, you need not what? Find out using forward rates, etc. These are readily available what? Market data. So this is not, there's no nothing called as what? Pricing. There's something called as what? Valuation. So how to value currencies we want to discuss in the last layer. So these are all the issues to be discussed. Can I say? So what to be discussed here? How to transform a dollar asset into pound asset, a dollar liability into what? Pound liability. Transformation of asset and liability using what? Currency swap is issue number 1. Yes or no? Issue number 2 is how can we make arbitrage using what? The currency swap market. Number 3 is how to value what? Currency swap. Are the 3 issues we'll be discussing in this area called as what? Currency swap. One issue is missing is swap pricing. Anga Libor against 8%. We found it or not? 11% against 8%, no need to find out because today in UK interest is what? 11%. US interest is what? 8%. Why to find out? Yeah. It is readily available. Spot interest rates are what? Available. 5-year bond is trading at 11%. 5-year bond is trading at what? 8%. Exchange 11 against what? Now both are fixed rate. Like, yeah. Both are what rate? Fixed rate only. There's no floating rate here. Hence we don't need to want to find it out. Did you follow what I am discussing or not? No. So this is regarding the issue should be discussed in this chapter called as currency swap. Shall I proceed or not? Okay. Question number 1. Those understood till now, raise your hand. Can I go to question number 2? These questions will give us examples for uses of the swap also help us to understand what? Transformation. Why these instruments are existing and understand through the questions itself. Okay, now take question number 2. Number, please. I'm hearing voices. Please, don't talk. Now, take question number 2. 2 and 3, we should try to complete before 7:50. Before what? 7:50. Then, I have to complete question number 5, question number 6, question number 7 before what? 8:45. So that only one sum, that is what? Question number 8, swap valuation, do in what? Next class. Question number 9 has been already done by us. When? Before you all came, I started the sum. Okay, today only we did. Okay. Question number 10, I'll give it as homework, is a solved problem. Same way, question number 4 also given as homework, is there in a practice manual. Okay. Those two sums are there in the practice manual. 10 I have given the solution, 4 we can just refer one practice manual, no concept. Okay. Remaining you should complete today except for one question. Can I start or not? Please. Shh. Listen to the transaction, please. Shh. IBM has taken a loan denominated in dollars for 15 million at 8% interest. First of all, IBM has taken a loan or not? It has borrowed in home currency or foreign currency or home currency. It is having a home currency loan of what? $15 million. At how much percent? 8%. Shh. This loan it is happy because no need to convert. It is having what loan here? Home currency. Shh. Now, but IBM wants to convert the loan into what? Sterling. Sterling means what? Pounds. Because it has now got a new order for export to UK and expects to get a perennial pound inflows which it wants to use it to service loan without what? Conversion if it is in pounds. Understand the situation here. Now, IBM has borrowed some money in what? Dollars. Maybe to purchase a machinery or something and is having a dollar loan, has to pay interest in what? Dollars. Now at the time of borrowing, it did not have any foreign exchange exposure. It is happy with the dollar loan. Yes or no? But now suddenly IBM got an export order. Got what order here? Export order. 5 years a perennial exporter is going to what? Get. Now tell me, IBM is exporting to UK now. It will get inflows in dollars or pound. You get inflows in dollars or pound? Pound. Look at the company situation here. It is having an inflow in pound or not? Yes, if it does not have any expense in pound, does not have any expense in what? Pound. Naturally, it has to convert all the inflows into what? Dollars and keep the bank account or not? Yes, it is exposed to a currency risk or not? Yes, this company thought, somehow I should create a pound expense. This companies do very easily. Somebody can create what? A pound expense. How can I create a pound expense? It says, why can't I convert my dollar loan into what? Pound loan. So that when the inflows from export comes, I can use it to service what? A pound loan, so that I need not convert money too frequently. See, netting is possible only when I have an inflow in foreign currency as well as what? Outflow in foreign currency. See, for this company IBM, now when it got an export order, it has got only what? Inflow in foreign currency. All its expenses, including the liabilities, all are in what? Home currency. It is not having any chance to use a foreign currency, so it will want any foreign currency expense. So IBM thought somehow I should avoid conversion. What conversion? I want to hedge my export. I want to hedge my what? Export. Instead of going for a forward cover, instead of going for what? Money market dates, instead of going for what? Currency option or what? Currency which is going to hedge his export. Going to hedge his what? Export receivable through netting. How through netting? Netting, I require a foreign currency outflow or not? It is going to create an outflow by converting the dollar loan into what? Pound loan. How is that? Loan is already in dollar. How can I convert it into a pound loan? Erase a dollar, put pound. No, we can convert it by using what? Currency swap. Using what? Currency swap. In that case, I'll be getting an exposure. It's going to be in what? Pound payable. I'll be using it to what? With the help of receivable, and to some extent, I get what? Some stability in the cash flow is the idea IBM is having. How it can be done, you can see through the flow diagram. Up to this, I'll have the clarity or not. No. Shh, don't. Next. Same way, British Petroleum has borrowed money in what? Pounds. At how many million? 10 million. At what percent? 11%. Wants to convert to what? Dollar denominated loan. For some other reason, it may feel interest rate is going to decrease or something in dollar, etc. Some reason it is having opposite requirement. Okay, into dollar denominated loan. Explain how the swap transaction can be used to convert the loans in one currency to what? Another currency is the issue that has been asked in this particular question. Everybody understood or not? Yes, you need not do anything to answer this here. Only thing is, why you know, okay, so draw only the flow diagram. All remaining is what? Typed and given to you. Let me draw the flow diagram and then give you time to copy it. Please don't touch. Please. See, it may seem to be a joke for you, but you are creating noise now. Understand how to shout above my voice, strain created, and it becomes tiresome. Efficiency is going to reduce. Yeah, please. Some amount of respect if you have, please give me the silence to complete the portion here. And always you should not be like this. Shall I proceed? Now, interest flows. All of you participate. There is a lender to IBM. There is a lender to what? British Petroleum. Can I proceed? No. IBM has borrowed. IBM has what? Borrowed. How much money? $15 million. It has borrowed what? $15 million. And it is paying what interest? 8% interest. Or not? British Petroleum has borrowed in its balance sheet how much million? 10 million. And then is paying how much interest? 11%. Simply, it wants to convert the dollar loan into what? Pound. And that party wants to convert the pound loan into what? Dollar. What you want to do it in what world? Swap world. Do it in what world? Yeah? Swap world. ரொம்ப simple. IBM wants to pay what interest? Wants to pay what interest? Pound. So pay pound interest in what? Swap. And receive what? Dollar interest in swap. Now example, you have to construct, yeah? Yes, I will not come there and draw diagram and draw like crazy Mohan. Can I say? So now you have to what? Construct. First of all, IBM wants to pay what? Wants to pay what? Pound. In the swap, it is going to pay what? Pound interest and receive what? Dollar interest. Point number one, everybody, yes or no? That means IBM has to pay pound interest. Now, you just imagine like this. The notion principle is what? Going to come in how much? 10 million pound and pay how much interest? 11%. Like that is going to receive what? Dollar interest. Now in the swap, it should be giving what? $15 million and receive what? 8%. Please understand that this 10 million, 15 million need not be exchanged today because both are of what value? Equal value. But the other end, it should be reversed. The 10 million which I received now should be what? Repaid. The 50 which I given is going to be what? Received back. That should happen because of different currencies. That is why I am writing the initial cash flow as an inflow and outflow to know that it should be reversed back at what? End of the 5th year or something. Everybody have the clarity. So this is a transaction. This is what? A transaction. Now let us see what happens every year to understand the impact of this. I will discuss from IBM's viewpoint. Now see, IBM each year. Year 0, nothing happens here. It is going to be a inflow, outflow, net off against what? Each year. Okay. First year, second year, third year, fourth year, fifth year. What happens here? IBM pays 8% interest to its lender. Yes, sir. But it receives what? It receives what? 8%. It receives 8%, pays what? 8%. And pays for the swap how much percent? 11%. That means effectively it is receiving 8% dollar interest from the swap, paying 8% to what? Lender. These two gets what? Cancel and pays 11% for what? Swap. Now tell me, ultimately the effective interest rate for IBM every year how much? 11% pound interest. 11% what? Pound interest. Should it convert and pay this pound interest or no? It has made some export or not? When we get export realization in pounds, some part of it will be what? Used to pay what? Interest. To that extent I can avoid what? Conversion. Avoid what? Conversion. So this is a use of what? An interest is the inflow is in what? Foreign currency. I make a funding also in what? Foreign currency. This happens for the first 5 years. Now, 5th year. What happens in what? 5th year. 5th year, IBM has to repay the dollar loan or not? It will repay the dollar loan out of the swap inflow which BP gives IBM. British Petroleum repays a principal of $15 million IBM or not? This inflow, reverse swap inflow, will be used to settle what? Lender. Understood? And then it has to pay what? 10 million pound to what? British Petroleum out of its export realization. Everybody, yes or no? Suppose you have a lesser interest in first year, lot amount to pay in one next year. Now deposit the balance money every year in what some foreign currency bonds and then release it to settle what payables also. So this can be done by IBM so that its full export relation can be to hedge some extent what hedge very effectively. Did understand the transaction? Should I repeat once again? Can I proceed? Okay. Now all of you should tell me. I am not repeating. You should tell me the transaction. First of all. Tell me the four parties. Lender, IBM, British Petroleum, lender. IBM has deposited money, borrowed money. In what currency? Home currency. What home currency? Dollar. It has borrowed $15 million and agreed to pay what? $8 interest. British Petroleum has borrowed in what currency? Pound. How much has borrowed? 10 million pound and agreed to pay how much? 11% interest. Is the transaction number one? Yes or no? Suppose I get an order, I get one order where some foreign currency inflows are going to get for what? IBM. IBM in the next year onwards is going to get dollar inflow, pound inflow, pound. The pound inflow they don't want to convert into dollars. They want to use it. They want to use it. Unfortunately, all their liabilities and expenses are in what? Dollar. So they want to change at least some portion of it into what? Pound. So they want to convert this dollar loan into what? Pound. That is done through what swap? Currency swap. Like that, BP can be having an opposite requirement. People can have number of reasons to enter into what? Swap transaction. There's an opposite requirement. So both enter into what? A currency swap transaction. Point number 2. Yes or no? In the currency swap, what you want, you do it in what? Currency swap. So IBM wants to pay dollar interest, pound interest. So pay what? Pound interest. In the currency swap, what you do is receive 10 million pound and pay what? 11% interest. Yes or no? Same way in currency swap, since I have to pay pound interest, I have to receive what? Dollar interest. By giving you how much pound? 15. By giving how many dollars here? $15 million. This is a swap transaction. Yes or no? No. Today, should this 10 million, 50 million be exchanged? Need not be exchanged? Need not be exchanged. Can I say no? No. Every year, tell me from IBM point of view, enough. Okay, every year tell me IBM, what happens here? IBM is going to what? Receive dollar interest from what? Swap. Pay dollar interest to what? Lender. It is going to pay 11% pound interest for what? Swap. Now tell me, ultimately, every year, what the net interest cost of IBM? 11% pound interest. What interest? 11% pound interest. Now, I want an answer. This 11% pound interest is home currency, cash flow, foreign currency. How we can meet it? It is having a receivable in foreign currency. Through the export realization, some part have been transferred to what? Interest payment. To that extent, I need not repatriate and convert. So to some extent conversion is what? Avoided. So this can be used as a part of what? The hedging tool also. Point number 1, yes or no? Last year, IBM last year has to repay principal or not? He has to repay how much principal? $50 million. Where to go for $50 million? Get that $50 million from what? British Petroleum as a reverse swap. Get that as what? $50 million and then what? Repay the lender. Now it has to pay 10 million pounds to the British Petroleum, the currency is some transaction or not. So how to pay 10 million pounds here? Out of my export realization, pay what? 10 million pounds. Is what I just said. Suppose you have a mismatch in cash flow, sir. Export is not as, export is even, but this is a big cash flow. Now, every when you have an export realization, a part of it will be used for what? Paying the dollar as a pound interest. Balance you deposit in what? UK market is a money market, and then what? Use it to settle in the final settles. So this is what we call as what? The currency swap as a transformation. It has literally transferred a dollar loan to pound loan, or a pound loan to what? Dollar loan. Hedging is secondary. I only want to show how I can transfer a loan of one currency to what? Another currency without touching the loan using what? Currency swap is subject matter of discussion. Yes or no? Yes, understood? Yes, okay. Now, notes you need not write. Why? Typed and given. IBM has a dollar loan, wants to convert into pound loan so that it can, so that its export realization can be diverted to service loan and thereby avoid conversion as well as what? Exchange rate risk. The dollar loan is converted into pound loan using what swap? Currency swap. Each year IBM pays to its lender 8% dollar interest using inflows from the British Petroleum from currency swap. It pays 11% pound interest to British Petroleum out of what? Export realization. On the maturity date, it settles a lender $15 million by collecting the same from what? British Petroleum as a swap inflow. It has to pay British Petroleum 10 million pounds, which it does through what? Export realization. Effectively, it has converted the dollar loan into what? Pound using the currency swap. Is what I just wanted to communicate. Sulupa, yes or no? Let's go to question number 3. Let's go to what? Not copied, huh? Copy this diagram quickly. Finished, huh? Finished, huh? Put the arrow marks correctly. Some of the batches they draw wrongly and then ask me doubt. Okay, that's it. Those are not copied, raise your hand. Finished, huh? Finish copying, huh? Shall I proceed? Now, take question number 3. Please. British Petroleum has stop talking. British Petroleum has deposit with Barclays for pound 10 million. Foreign currency deposit home currency. Home currency. At what percent? 11%. It believes that dollar is going to appreciate and hence wants to convert it pound deposits to dollar denominator deposit. Okay, now let us see the British Petroleum's mindset. They have some surplus pound money which they make FD, which they make what? Deposits. They deposit with a foreign bank, local bank, local bank. What bank? Barclays. And how much? 10 million pound. At what percent? 11%. This they have made already. The deposit has been what? Already made. Now they feel that dollar is going to appreciate. Dollar is going to what? Appreciate. We all know dollar will appreciate because 8% dollar interest will making dollar what? Appreciate. What he feels that it may appreciate more than IRPT. That then only people will go into transaction, will appreciate more than what? IRPT. He is very much bullish about it. Very much what? Bullish about what? Dollars. Bullish about what? Dollars. Or bearish about what? Pound weakening. He does not want to have a deposit in a weak currency. He doesn't want to have deposit in what? Weak currency. He wants somebody in what? Strong currency, because when he realizes, he should not realize a weak currency, he should be realizing what? Strong currency to get a maximum one conversion. So he wants to deposit in what? Dollars. So that when the dollar releases, he'll be having what? A very strong rate and get converted into what? More pound than what he'll be getting as a pound deposit. Now, that is why British Petroleum does not want a dollar deposit. Void does not want a pound deposit. Void has made as a pound deposit, wants to convert into what? A dollar deposit. Is the requirement of a British Petroleum. Understood? Answer me. British Petroleum is having a dollar deposit, a pound deposit. Is a foreign currency or home currency? But now, through their currency analyst, it came to know that dollar is strengthening. Dollar is what? Strengthening. Not normally, but what? Very much. More than what? IRPT. He is here. Guess about what? The dollar rates. Now tell me, they want to have dollars after 5 years, a pound after 5 years. They want a currency which is having what? A huge value after what? 5 years. So they want to make this pound deposit into what? Dollar deposit, so that they'll be in the side of a strong currency after what? 5 years. That's what British Petroleum is thinking about. And all its calculation is based on an assumption that dollar is going to strengthen very much more than what? IRPT. So he's speculating about the dollar rates and hence wants to shift the money to what? US for deposit. Point number 1. Yes or no? Next. On other hand, what other company? IBM. He is having what deposit? Dollar deposit. How much million? 15 million. At what percent? 8%. It wants to convert into what deposit? Pound. Why? It may have some other reason. May have what? Some other reason. Why it wants to convert to pound? Because it has imported what equipment? Capital equipment from what? UK, and has taken a pound denominated loan to settle what? Import. Romba simple. This IBM has imported a machinery from where? From UK. So it has to settle the import or not. So to settle that, it borrowed what? A pound denominated loan. What I'm saying now? Look at the IBM balance sheet. It is having a dollar denominated deposit. It is having a pound denominated what? Loan. That's a balance sheet mismatch or not? So they want to hedge their balance. They want to hedge their balance sheet. So what they want is the dollar deposit have or not. This they want to convert into what? A pound deposit, so that the deposit interest which they want to receive in what? Pound can be used to settle what? The pound denominated interest and so on. So this is the reason why they want to go for what? A pound denominated deposit. Did they understand the reasons or not? I am just giving all these examples only to show why a company can enter into what? A currency swap. There can be n number of reasons why companies can enter into what? A currency swap. They all can join together for various reasons. Can I say it now? First of all, what British Petroleum is at present having? Pound deposits. They want to make it into what? Dollar. So that they want to be in the side of dollar when it's strengthens. And the IBM is having what deposit? Dollar deposit. But they are now having a borrowing in what? Pound. They want to convert the deposit into what? Pound, so that the pound borrowing can be paid using what? A pound deposit. So this is a requirement. So no. Can they go and change the FDs? So what? They cannot even do the pre-closure. So what they can maximum do is what? They can convert using what's that? Using what's that? Currency. Yes or no? No. Shall we go for the solution for this sum? Let us draw the diagram together. In the sheet, I have given a space or not? Please draw the diagram. Have these four parties. A borrower from IBM. IBM made a deposit not? A borrower from IBM. A borrower from British Petroleum. Okay. Tell me the flows here. First of all, IBM deposited how many dollars? Good evening, friends. Shh. If you drag me, unless I complete my target, not allow you out. Okay. The farewell, start to 9:30, you left or not? Like that, you sit here and listen and want to go. Can I proceed? IBM has deposited in what? Dollars. How many dollars it deposited? It deposited $15 million. deposit $15 million and is receiving, Solapa is receiving how much interest? How much percent interest here? 8% interest. With Barclays, British Petroleum has deposited how much money? 10 million pounds and is receiving how much interest? 11% interest. Suddenly they have a change of mind. They want to transform to other currency. Okay. IBM wants to pay dollar interest, pound interest. IBM wants to receive dollar interest, pound interest. IBM wants to receive what? Pound interest. So in the swap, it should receive pound interest, pay pound interest, receive. So IBM wants to receive pound interest now, should make what? Pound deposit. 10 million pound is depositing in the swap. It is giving 10 million pound to what? British Petroleum to receive how much interest? 11% pound interest. To receive 11% pound interest. British Petroleum wants to receive what interest? Dollar interest. So it is going to give $15 million to receive what? 8% dollar interest. It is going to give $15 million to receive 8% dollar interest. With clarity, are you all writing? With 8% dollar interest. My question is, I said it should give 10 million pound to receive what? 11%. It should give $15 million to get what? 8%. Should it give 10 million pound, $40 million? No. These two will be what? Knocked down. So initially notion principle need not be what? Exchange. I just imagine to be exchange, that's all. It will not be exchange. Point number one, yes or no? All of you following or not? No. Answer is over. The answer is what? Over. Now let's see the effective interest earnings of what? All of them. So first, think about IBM. Think about what? IBM. IBM receives what? 8% dollar interest from what? Its borrower. Then it is going to use it to pay what? Swap 8% interest to British Petroleum. Yes or no? It receives what? 11% interest from what? British Petroleum. Literally it has converted a dollar interest into what? A pound interest receipt. Yes or no? This is the objective of my sum. The main objective is when they get the 11% pound interest, that can be used to settle what? The pound interest always they have what? Borrowed from elsewhere, thereby avoiding the conversion. This is point number one. So what happened is IBM has effectively converted a dollar deposit into what? Pound deposit and started receiving what? 11% pound interest year after year. So when they receive the interest in pounds, they have a liability also in pounds or not that can be used to settle this and conversion, e-conversion can be what? Avoided to greater extent. Point number one, yes or no? Last year, what year? Last year. IBM will be receiving $50 million or not? From the borrower, they will be repaying the money to IBM, be receiving back what? $15 million. This it is going to use it to give to what? British Petroleum the $15 million as a swap cash flow. Response, yes or no? And then it will be receiving, it will be what? Receiving from British Petroleum how much million pound? 10 million pound. That can be used to repay my loan in pounds. That can be used to repay my loan in pounds. Effectively, it has hedged this balance sheet. Am I right or not? How I said in interest as well, bank is having a floating rate and what? Fixed rate. Balance sheet is having a risk or not. So the risk can be avoided. Same way I'm having a dollar loan, a pound loan and then what? Dollar deposit. By converting the dollar deposit into what? Pound deposit using currencies, I hedge my balance sheet risk. This one, have the clarity. Yeah. British Petroleum, see, reason is other. It is speculative. It is what? In the market, there can be so many players here. One comes as speculator, another can come as what? Hedger, third can come as what? Arbitrage person also. So we'll always find a counterparty. The market is what? Very big. British Petroleum is not coming for hedging. It is coming for what? Speculation. It feels that the dollar is going to appreciate. It wants to have money in what currency? Appreciating currency, so that on conversion will be getting what? More number of pounds because of the strong dollar. So it has effectively converted that 11% pound interest into what? Dollar interest, because it receives 11% pound interest and pays what? 11% pound interest and receives what? 8% dollar interest. So BP also has converted its pound interest into what? Dollar, and same thing happens for what? IBM also. Did you understand the transaction? So this is regarding solution to question number 3. So what I said has been what? Explained in detail in the notes. Okay, now notes given. Question number 3, notes have been given or not? Yes. I need not read the notes because already has been what? Discussed. So with this question number 1, question number 2, Question number 3, question number 9. 4 sums have been completed. Ennappa, yes or no? Okay, now. Fourth question is given as homework. The answer is there in what? Practice manual. Practice manual is a dustbin called as Indian Capital Market. Okay, want to know how to see in what? That chapter only. In dustbin only, everything you put or not. Like all chapters is there in one chapter. What? Indian capital market. Allah swap futures also there, option also there. Dividend policy also is there in what? Indian capital market. So there if you go and search Google search, you'll be getting what? The drilled problem there. Can I say is there in what? Practice manual. Can I say that? But they can split into what? Number arts. Illame one chapter. All are different or not. So like our workbook they can have what? Different chapters. But institute we cannot correct. Can I say no? A systematic research. Take question number 5. How I do 5, 6 and 7 are revision subs. It is same. 5 alone I will explain. 6 and 7 we should do together. We should do what? Together. Take question number 5. We had arbitrage. That is the risk premium in one will be more than what? Other. I borrow for you, you borrow for me, we pay for each other. Same way. Same type of sum we are going to do here only, but that is fixed float. It is going to be what? 2 currency interest rates. Here 1 or 2 extra issues are involved. What it is we are doing at the time of solving the sum. So take question number 5. See, today we will not go home unless I complete 5, 6 and then 7. This is target here. Please, don't talk. If we talk, we will not go home. Can I say? No. Following is the interest rates at which General Motors and Qantas Airways can borrow in 2 currencies. General Motors is US based company. Qantas Airways is what? Australian Airlines. Okay, please. US dollar and then Australian dollars. Don't talk. General Motors can raise money in US dollar at 5% interest rate. Can raise in Australian dollars at 12.6% interest rate. Same thing for QA, it is 7% and then 13%. General Motors wants to borrow in Australian dollars. They want a foreign currency loan. Qantas Airways wants to borrow in US dollar. A financial institution has offered to arrange for a currency swap with a dealer's margin of 0.2%. Explain how a swap can be structured to the benefit of all the parties under the following 2 situations. A. Financial institution bears the exchange rate risk. How can it hedge? Qantas Airways bears the exchange rate risk and the financial institution earns 0.2% dealer's margin in dollars. In these 2 situations, they ask you to construct a swap transaction to achieve the desired result. This is the question. Okay. I'll just give a minute time, observe the interest rate and read the question, then we can just start with the solution. No time, we can just complete the answer quickly, not an issue. Go through the question quickly first. Shall we start? Please listen. Now, General Motors is a bigger company and it is enjoying a much more higher credit rating throughout the world. Okay. But QA is a little bit lesser compared to what? General Motors. So wherever they go, General Motors can borrow at a lower rate because of their standing. It is going to be opposite for what? QA. Okay. Now, General Motors, when they borrow in US, they can borrow for 5%. In Australia, how much percent? 12.6%. Other countries prevailing interest rate. QA can borrow in US at how much percent? 7%. In their home country at what? 13%. These are details given. Can I proceed? Now, see. General Motors wants a foreign currency loan. Want a foreign currency loan. What is foreign currency? Australian dollars. They want a loan in what? Australian dollar. If it is not meeting Qantas Airways, it will borrow at what percent? 12.6%. Agreed or not? Next. Qantas Airways, an Australian firm, wants to borrow in what? Dollars. They also want some foreign currency loan for their operations. Okay. If they borrow in US, had they not met what? General Motors, what the interest rate? 7%. So, if they don't meet each other, General Motors will borrow how much percent? 12.6. And Qantas how much percent? 7%. This is a normal way in which they can raise the money or not. This is how they can raise a foreign currency loan. There's an investment banker or a dealer who brings these two parties what? Together and say, see, you both are having what? A different compared advantage. Now, instead of you borrowing Australian dollars, if you borrow in what? Dollars, you can save 2% interest for the group or not. Instead of General Motors borrowing in what? Australian dollar, if they borrow in what? Dollars, they'll be able to borrow how much percent? 5%. Again, 7% what QA can borrow. So if you borrow in dollar, you can save 2% for the group. QA, you borrow in what? Your home currency called as what? Australian dollar. But you have to pay only how much extra? 0.4% extra premium. So, together you can save 2 minus what? 0.4, 1.6% interest for the group or not. You pay me 0.2% what? Commission. Share it what? 0.7% equally. So that's arbitrage or not. But then General Motors said, but I want what? Australian dollar interest. Don't worry. Convert using what? Currency swap. See, sir, I don't want Australian, I don't want what? US. I want only what? Australian dollar. No problem. I convert it using what? Currency swap. How the swap should be structured to achieve the objective is subject matter of discussion. Did you follow what I am discussing? Yes, sir. Now, all of you answer me. Has General Motors borrowed on its own? What is the interest rate? 12.6 Australian dollars. Has QM borrowed on its own? What is the interest rate? 7%. Yeah, US company wants to borrow in Australia. Australian company wants to borrow in what? US. If they do that respectively, they'll be paying 12.6 and 7%. Point number 1, yes or no? But General Motors is going to borrow in US. QA is going to borrow in what? Australia. Due to which it is saving 2% premium and is paying only what? 0.4% premium. The net savings how much? 1.6%. Pay commission what? 0.2. Share it what? 0.7 equally. Yes or no? Sir, but sir, I want money in Australian dollars. You may be borrowing what? Dollars. Don't worry. Using currencies, convert the dollar loan into what? Australian dollar. Sir, I want dollar. You may be borrowing what? Australian dollar. No problem. Convert the Australian dollar loan into what? Dollar using what? Currencies. So they can enter in the swap with what? A dealer who wants to make how much dealers margin? 0.2%. How it should be structured is a question. Did you understand the question number? Can I pass it? Write down question number 5. Write question number 5. We have to write the answer for these 3 questions in notebook. Now, I don't want to draw the diagram and make you copy, do it together. Okay, question number 5. Question number 5. Step 1. Calculating effective interest rate after swap. Question 5, step 1. Calculating effective interest rate after swap. Calculating effective interest rate after swap. We'll have this as a target and then draw the diagram. Can I say calculating effective interest rate after swap? Right on. Swap gain is equal to now tell the say number 2%. You want to write the formula? Swap gain is equal to home currency interest, difference in home currency interest minus difference in foreign currency interest Anga floating fixed. Home currency and what? Foreign currency. Anyway can say difference in home currency interest minus difference in foreign currency interest minus what? Dealer's margin. Minus dealer's margin is equal to 2% minus 2% minus 0.4%. 2% minus 0.4% minus 0.2% is equal to 1.4%. 1.4%. The gain is shared equally. Next line. The gain is shared equally at how much percent? 0.7%. The gain is shared equally at 0.7%. The gain is shared equally at 0.7%. Next line. GM interest rate. GM means what? General Motors interest rate after swap is equal to GM interest rate after swap is equal to without swap. Tell me how much I pay. $12.6. Right, the interest rate prefix put what interest rate? $12.6 minus how much is the gain? 0.7%. Correct? $12.6. $8 means what? Australian dollar 12.6 minus what? 0.7%. Either before swap minus what? 0.7 gives how much percent? $11.9. I should construct the flow in such a way that I should be ending with what? 11.9% $8 payment. So no. So $11.9. Can I say next? QA's interest rate after swap. QA's interest rate after swap. QA's interest rate after swap. So without swap what interest rate? $7%. $7% minus what? 0.7%. Correct? $7% minus 0.7% is equal to how much? $6.3. $6.3%. $6.3%. Step 2. Interest rate flows. Step 2. Interest rate flows. Interest rate flows. Shall we start now? No. Let us have the various parties. In middle, have a space because there's going to be a bank coming in between. Yes or no? Who is going to be the swap dealer now? So have a space in the middle because I'm going to have a lot of arrow marks drawn. So left, say LHS, RHS, center have a lot of space left. Okay, now. Can I say? Shall I start now? Now, first one. General Motors, all of you are going to do it together. General Motors wanted to borrow. So, wanted to borrow what? Australian dollar. But has borrowed in what? US dollars. And pays to its lender how much interest? 5% interest. I want an answer. Yes or no? Yes, there must always be clear with the strategy. General Motors wanted to borrow what? Australian dollar. But now borrowing what dollar? US dollar. And paying how much interest? 5% Australian US dollar interest. This one is or no? No. Now you should answer me. QA wants to borrow in what? US dollar. But for the purpose is borrowing in what? Australian dollar. Pays how much interest is rendered? 13%. So this is a present position. So GM is paying 5% dollar interest and QA is paying what? 13% $8 interest. Are they happy with the position or no? Because GM wants a Australian dollar loan and QA wants what? A dollar loan. They have to convert the loan into other category using what? A currency swap. Enter with the person called as what? Dealer in between. A person called as what? Dealer in between. Everybody yes or no? Now, to construct only, I did the step number 1 here. First, GM get target fix. You do GM, automatically answer will be got. Okay, now, General Motors wants to pay ultimately what interest? How much interest? Yeah, 11.9% Australian dollar interest or not? He wants to receive a pay. Pay. Remember, pay 11.9% what? Pay 11.9% what? Australian dollar interest and receive what? 5% dollar interest. Either General Motors matter over. Yes or no? So pay how much Australian dollar interest? 11.9. What you want? Do it in what? I know the answer is what? 11.9. So pay 11.9 Australian dollar interest and receive what? 5% dollar interest. Ennappa yes or no? Now tell me, after this swap transaction, General Motors effectively pays how much interest? 11.9. It receives 5% from what? Dealer, and pays 5% to what? Lender, and then pays what? $11.9% to what? Dealer. Effectively converted the dollar interest to what? Australian dollar interest. What how much? 11.9%. Everybody yes or no? Same thing you tell for Qantas Airways. Qantas Airways ultimately wants to pay how much? How much percentage? 6.7%? 6.3% dollar interest. So in the swap, pay what? 6.3% dollar interest. And receive what? $13%. Receive how much? $13% interest. So this is a swap entered in between what? QA and the dealer. QA and what? Dealer. One or two issues involved. All of you are listening up to this or not? No. So, Qantas Airways is receiving how many Australian dollars? 13%. Paying what? 13%. And then paying what? 6.3% dollar interest. At the end of the currency swap, it is now making how much interest? 6.3. Had they not done this G would have been paying 12.6. Now it is paying only how much? 7.9. This Q would have paid how much? 7. Now they pay only what? 6.3. So they reduce the interest using what? The arbitrage. Is point number 1. Yes or no? Now, General Motors story over. Qantas Airways story what? Over. One person story is who is that? Dealer. Who is the person here? Dealer. The dealer is having a story to tell or not? For dealer, one headache is that he is making 0.2% interest gain. Yes, not in one currency, across two currencies. Yes, look at this here. He is receiving Australian dollar 11.9. Yes, paying what? Australian dollar 13%. He is suffering 1.1% Australian dollar payment. Yes, he is receiving what? 6.3. And paying what? 5. How much is he earning? He is earning 1.3% interest in dollars. He is losing 1.1% interest in what? Australian dollar. Thus he is earning what? 0.2% net interest across two currencies. Across what? Two currencies. If you don't net it, it cannot net it off. If you see his position, he is having a receivables in dollars. He is having a payables in what? Australian dollar. He is having currency risk or not? This dealer tries to avoid this by finding out some other party having an opposite swap. That is, two parties not enough. You're going to get to want some other party where you can be offsetting each other, where you can be having a swap where I can make a gain in what? Australian dollar, loss in what? US dollar. Now, I'll be very happy. It need not be only one swap between dollar and Australian dollar. You can have Australian dollar and French franc. You know, interest is your portion. He is having a gain in US dollar 1.3. In swap, he is going to pay how much? 1.3 US dollar. In swap, he is going to receive what? 1.3% US dollar. In the swap, he is going to pay what? 1.1% Australian dollar. Yes or no? No. Australian dollar payable is that. US dollar what? Receivable is that. Some other swap where he may be having an Australian dollar what? Receivable. That can be used as well as what? Payable also, because he is not a one-party person. He is going to be what? A dealer having lot of swaps or not. And the swap need not be against Australian dollar and US dollar. Even in Australian dollar, I don't want a pound also, because I want only one leg to be knocked off here, and US dollar can be having another swap also. So everyone will be seeing lot of combinations. What cannot be hedged ultimately, he'll be either going for what? A forward cover, or also going for what? An international market where he can go and take what? Opposite position to knock off his transaction. Everybody have the clarity or not? No. This is what the currency swap happens. Now tell me, who is bearing the exchange risk? Dealer. That is what I want to write next. Up to this, finish copying. Yes, step 2 or step 3? Step dealer's margin. Step 3, dealer's margin. Particulars, dollar, Australian dollar. Dealer's margin, particulars, dollar, and then Australian dollar. Dealer receives as well as what? Pays. Help me out. Dealer receives how many dollars? 6.3% dollars. Receive and pays how much dollar? Receives how much Australian dollar? Pays. So net is going to receive 1.3% in what? Dollars. And minus 1.1% in what? Australian dollars. Shall I proceed? Write down last line. The dealer has inflows in dollar. The dealer has inflows in dollar and outflow in Australian dollar. The dealer has inflow in dollar and outflow in Australian dollar. Hence, he earns spread across two currencies. Hence, he earns spread across two currencies and thus bears the currency risk. And thus bears the currency risk. And the question is specifically said now, first part of the question is what? Financial institution bears the exchange rate risk, yes or no? And thus bears currency risk. This can be hedged by finding offsetting swap transactions. This can be hedged by finding offsetting swap transactions. By finding offsetting swap transactions with other customers. By finding offsetting swap transaction with what? Other customers, or taking position in dealer's market. Or taking position in dealer's market. You may be requiring to pay 1.1 Australian dollars. Some other dealer may be having a position. I want to receive what? 1.1 Australian dollar. You too can go for what? A transaction. So or take position in what market here? Dealer's market. So this is regarding the hedging. Are you following what I am discussing? Next. Part 2 question is now. Financial institution says, it is only a choice here. They say, I cannot find out the corresponding hedging and all. I want 0.2% in one currency. What currency? One currency. That too dollar is famous. I want 0.5% in what currency? Dollar currency. Institution said. And in this case, the person called as what? General Motors says, due to SAP, you are only mostly benefited. And I am only having a higher credit rating. Swap working only because of me, mainly. So what I am saying. So he said, Qantas Airways, you bear what? The currency risk. You bear what risk? Currency risk. In that case, how the swap transaction will be what tailored into is the next issue. One of the exam RTP question, this has been tested. Yeah. Can I say no? All of it, listen. Now tell me. Qantas Airways bears the exchange risk and the financial institution earns what? 0.2% dealer's margin what currency? Dollars. In this case, how to do? Okay, now, whoever bears the risk will be the balancing figure. Yes or no? When I have drawn the earlier diagram, I thought about General Motors. I thought about what? Qantas Airways. I did not think about dealer. When I think about the two, he is a balancing figure or not? Now when I construct the diagram, I'll think about what? General Motors. I'll think about what? Dealer. The balance is what? Qantas Airways. Let us see what is going to happen. Can I proceed? I know. Step 2 or step 3? Step number 4. Step 4. Interest flow diagram. Interest flow diagram. When QA bears the currency risk. Interest flow diagram. When Qantas Airways bears the currency risk. When QA bears the currency risk. Okay. When Qantas Airways bears the currency risk. Same diagram, leave a space in the center and then copy left and right. Finished now. Let's start with the diagram. Tell me. General Motors. Answer soluba. General Motors wants to borrow in what currency? Borrows in what currency? Dollars. Pays how much? $5 interest. 5% dollar interest. QA wants to borrow in what? US dollar. But borrows in what? Australian dollar. Pays how much interest? $8, 13%. Okay. Let's finish off first the General Motors side. Okay. Soluba. General Motors ultimately wants to pay target barba. Wants to pay how much interest? General Motors ultimately wants interest. Yeah. 11.9% $8 interest or not? So pay 11.9% $8 interest and receive what? 5% dollar interest. Receive 5% dollar interest. GM over because 5% receive, pay 5%, pay 11.9, effective is 11.9 $8 interest. Yes or no? Now you will think about QA or dealer. We all know that dealer wants. Solupa, dealer wants how much? 0.2% gain in which currency? That means one thing sure, it is going to receive 5.2% dollar. And pay what? Australian dollar 11.9. $8 should be exactly offset. I want money only in what? Dollar. So now tell me, dealer will receive what? 5.2% dollar interest to make that 0.2% gain in dollar. It should not have gain or loss in what? $8. It does not want to take any exposure in what? Australian dollar. So what he is going to do? He is going to knock off the $8 by paying how much? $8, 11.9 in what? The swap transaction. In the clarity. This is what has happened to what? Dealer. Now tell me three parties. General Motors. General Motors receives what? 5%. Pays what? $5%. Pays what? Australian dollar 11.9. Effectively it has made how much loan? Australian dollar 11.9%. General Motors over and up. Dealer receives what? $5.2 interest. Pays what? $5 interest. How much again? 0.2%. Next, receives what? 11.9. Pays what? 11.9. No cash flow in Australian dollar and cash flow how much? 0.2% in what? US dollar. Making profit in one currency, no risk. But the problem is with what? Qantas Airways. Okay, now let us see what happened to Qantas Airways. Then we'll write it. Okay, now look at QA. It is receiving what? How much it is here? 11 point. It pays what? That means in its home currency, it is suffering a loss of 1.1%. Yes or no? Yes, sir. It is suffering a 1.1% Australian dollar interest loss in the home currency. Point number one. Yes or no? Yes, sir. Now, it is paying how much dollar interest? 5.2. Had it not gone for this swap, it will be paying 7% or not? Yes, it would have paid how much percent? 7%. Now paying only what? 5.2. It has saved 1.8% dollar interest or not? It is able to save 1.8% dollar interest because it is paying what? 1.1% Australian dollar interest. Yes or no? Effectively saved what? 0.7 interest in one currency across two currencies. So are you follow what I am discussing or not? It is having a lower dollar interest payment because of paying what? Some extra money in what? Australian dollars. Having the clarity or not? No. Right on. For Qantas Airways, right on. Same step you continue, complete it. For Qantas Airways, it has saved 7% minus 5.2%. It has saved 7% minus 5.2% is equal to 1.8% dollar interest. Is equal to 1.8% dollar interest due to swap. But for this, it is paying. $8 13% minus $8 11.9%. It is paying $8 13% minus $8 11.9% is equal to how much? $8 1.1%. $8 1.1%. Full stop. It has effectively saved 0.7% interest across two currencies. It has effectively saved 0.7% interest across two currencies. has effectively saved 0.7% interest across two currencies. QA will not mind this because for them the foreign currency loan has reduced from 7% to what? 5.2. To some extent, when you avoid an outflow in the foreign currency, hedging is also what? Happening. Home currency 1.1% is always a certain inflow only. We need not worry about it too much in the long run. Can I proceed? So this is the answer for the question number 5. I want a confirmation. Everybody following or not? Yes, in currency swap alone, ultimately one part will be a balance. We also bear what? An exchange risk. If you want to do the arbitrage, want to do what? Arbitrage. There can be an institutional one, a weaker party in the swap. Are you following? Now, next. One more sum I'll complete and leave you. Quickly. Lot of, one more, two sums I'll do and leave you. Question number 6. Take question number 6. Now, this sum I will not do it. You only should what? Tell me the answer. Can I proceed or not? No. Same type, yes. Question number 6. Take question number 6. Company X wishes to borrow in US dollar. Are you listening? Y wants to borrow in what? Yen. Please. Amount that the two company requires is roughly the same and at the current exchange rate. The companies have been quoted the following interest rate, tax adjusted. We ignore tax here. When the tax is different in different countries, that can even make an interest rate advantage. That's why whenever I write the interest rate, I should write interest rate what? After tax. That is the effective interest you're going to what? Pay or receive. Okay, please. In US dollar, X and Y has been given. Design a swap that will net bank acting as a financial intermediary made how much basis point? 50. That means what? 0.5%. Make swap equally attractive to both the companies and ensure that all the foreign exchange risk is assumed by what? Bank. That means bank is going to make the spread across what? Two currencies. Is the question. I have the clarity. Now, all of you, don't go by formula, go by what? Logic. First, X wants to borrow what currency? X want to borrow what? Dollar. So it will borrow how much percent? Y wants to borrow in what? Yen. About how much percent? 6.5. Listening, Now, if X borrows in yen, he can save for the group 1.5% or not? Yes, sir. If Y borrows in what? Dollars. It pays how much extra? 0.4. They can save 1.5 and pay what? 0.4. They can save together how much? 1.1% interest. After paying 0.5% as what? Dealer's margin. Effectively they can say how much? 0.6%. Stand equally as what? 0.3%. Let us do that first step. Then we can fix the effective interest rate as a target and then construct the diagram. Procedure. Right on first. Step 1. Effective interest after swap. Effective interest after swap. You can just simply write no need to write the formula. Home currency, foreign currency, for whom question arises na? Simply write, okay, swap gain is equal to 1.5% minus 1.5% minus what? 0.4%. This is logical apply. By borrowing in yen, they have saved for the group how much? 1.5. Why borrowing in dollars? I said how much? I have paid how much? 0.4 extra. 1.5% minus 0.4% minus what? 0.5% is equal to how much? 0.6%. Is equal to 0.6%. The gain is shared equally at. The gain is shared equally at how much percent? 0.3% each. The gain is shared equally at 0.3% each. The gain is shared equally at 0.3% each. Did you understand it? Effective interest after swap for X is equal to EFFINT after swap for X is equal to effective interest after swap for X is equal to, so look, had X not gone for swap, what is the interest rate? $9.6. $9.6. Now minus what? 0.3%. $9.6 minus 0.3% is equal to $9.3%. Effective interest after swap for Y is equal to, effective interest after swap for Y is equal to, normally Y pays how much? N 6.5%. N 6.5% minus 0.3% is equal to 6.3%. Is 6.2%. Is equal to 6.2%. N 6.2%. Step 1 or step 2 or step 2. Interest flow. Interest flow when bank assumes exchange risk. Interest flow when bank assumes exchange risk. Interest flow when bank assumes exchange risk. Same, lender X, lender Y. Shall I proceed on? No. X wants to pay, X wants to pay what interest? Remember, X wants to pay what interest? Dollar interest. But now pays what interest? N interest of 5%. Y wants to pay what interest? N interest. But now pays dollar interest of 10%. Dollar interest of 10%. In between, dealer is there. Let's complete X first. Tell me, effectively look at the first step and tell me, X wants to pay how much interest? What interest here? Dollar 9.3%. What you want, do it in what? Swap. X pays dollar 9.3% and receives N 5%. X pays dollar 9.3% and receives N 5%. Y effectively wants to pay, look at the question, tell me, Y effectively wants to pay how much percent? 6.2% in interest. So pay what? 6.2% in interest, receive dollar 10% interest. Pay 6.2% in interest and receive dollar 10% interest. Answer me, dealer is making gain in which currency? Yen. Gain in what? Yen. 6.2 minus what? 5. Gives you what? 1.2. He is making loss in what? Dollars. That is 10 minus 9 is how much? So net gain is how much? 0.5. Made across what? Two currencies having exchange rate risk. Yes or no? No. Next write down. Step 2 or step 3? Step 3. Dealer's margin. Step 3. Dealer's margin. Particulars dollar yen. Particulars dollar and then yen. Receive, pay. Tell me. Dealer receives how many dollars? 9.3. Pays how many dollars? 10%. Receives how much yen? 6.2%. Pays 5%. Net is minus 0.7% and then 1.2%. The dealer makes a 0.5% margin across two currencies. The dealer makes 0.5% margin across two currencies. The dealer makes 0.5% margin across two currencies. Across two currencies. With this, question number 6 has been what? Completed. One more, some target not achieved. Next class we will do question number 7. We are going to start next class once again. What time? 5:45 will start. Next class will complete the swaps quickly and then start with the mergers and acquisitions.